morning. I'm Julie Hyman with Jared Blickery in today for Brad Smith. This is Yahoo Finance Live. Let's get right to the three things you need to know to start off your morning. First thing you need to know, China has set its 2023 growth target to about 5%. That's its lowest forecast in decades. And this comes as the country looks to rebuild after its strict COVID-19 shutdowns and after it missed its target last year by a wide margin. This new GDP goal, along with plans for fiscal spending, suggests that China will not be as aggressive in propping up its economy as some China watchers had forecast. The announcement coming at the beginning of the National People's Congress meetings, which run through March 13th. Second thing you need to know, it's a busy week ahead for investors with comments from Fed Chair Powell on the docket and Jobs Day to end the week. Powell's going to deliver his semi-annual testimony to Congress and offer clues on what employment and inflation data is needed to affect the Fed's path ahead. He's widely expected to confirm the more hawkish tone we've recently heard from some Fed speakers. And Friday's jobs report is expected to show a slowdown in job creations for the month, with the unemployment rate expected to remain steady after an unexpectedly strong reading in January. Third thing you need to know, Tesla is slashing its car prices again. The EV maker trimming the price tag of its two most expensive cars, the Model S and the Model X. The basic Model S price was dropped about $5,000, and the cost of the basic Model X SUV was dropped by about $10,000. These price reductions are becoming more routine for Tesla these days as the automaker aims to become more affordable and also to boost its sales. Tesla's adjusted the prices of its cars already 5 times this year. China's leaders released a rather cautious outlook for the nation's economy this year with a growth target around 5% for gross domestic product. For more on China's tentative approach, we welcome in Ben Amons, New Edge Wealth Senior Portfolio Manager and Head of Fixed Income and Macro. Ben, good morning. It's good to see you. So just give us sort of your big picture impression, first of all, of this new growth target from China and also what it's going to mean for the rest of the world.
Morning, Julie. Yeah, it was a modest target. It's one target that you could think of that can easier beat than setting it at 6%. The other take I had, though, from it was that the fiscal spending target, they set at 3%, which was a little higher than last year. So it does indicate that they're willing to go on with fiscal expansion if needed, even though they set some cap on bond issuance. So all in all, if you take those details together with, actually more earmarked for defense spending too. And this is a GDP target that's going to be met. It's not going to be an economy that's like last year. So catching up from 3% to 5% in itself is already adding to global activity. So as much as there's a muted reaction on markets this morning, I do think it's a positive development and once again underscores China's commitment to keep its economy fully reopened.
Okay, so a little bit of disappointment here with maybe not as much stimulus to open the economy or reopen the economy as expected. But the money spigots, if you look at M2 growth, have been really on the forefront of investor minds this year. They've really exploded along with those of Japan. That's a separate story, of course. Just wondering what it means for the average investor in maybe Chinese stocks, Chinese ADRs, especially in light of all the, maybe I would say, some of the negative impact that the statements from Chinese officials and their actions have had over their securities over the last years. That's kind of been a dark cloud for investors on China. Any relief here in sight?
Yeah, the dark cloud hasn't completely disappeared because it remains somewhat unclear whether the crackdown is completely ended. And it's somewhat ambiguous too in the statements about what they're wanting to do from here. But one thing I did take from this GDP or this budget outline was that they're putting a lot of effort behind technology investment. There's some reports out by different think tanks that China has really leaped forward with technology in a lot of different spaces. You would think about artificial intelligence, for example. So that is money putting behind from China in those technologies competing with ours. And I think that should get investors' attention because that means no or little crackdown there. On the other hand, the infrastructure part, which is what a lot of people look at too, that may be something of to continue to watch. We have a property market that's in a slump. There's defaults there and liquidity problems. So what will that mean for the spillover on Chinese equities if investors continue to perceive that negatively? I think on balance, this is a modest report that should support the Chinese market, keeping it somewhat ahead of other markets, but maybe not with leaps and bounds.
Yeah, and we have been seeing some reaction in the commodity markets as well this morning, Ben, because there were so many hopes for China to restart its huge growth engine and consume a lot of commodities. I mean, they're still going to consume a lot of commodities, maybe just not quite as much as people had expected. Do you expect that effect on the commodity markets to be sort of short-lived?
Maybe it is, Julie, but here's an interesting factoid about the commodity markets in China. China last year really front-loaded its purchases of energy, especially when we had the sort of real tension in oil markets and they're traders. So they stepped in, I think, in an opportune time to get all this, not only foreign oil, but particularly Russian oil, obviously, that they imported. And that's, I think, why the oil price itself hasn't been reacting so positive to any news that coming out of China with regard to the economy. On the other hand, the metals have outperformed so significantly. I think that's where most of the pent-up demand still is, and whether it's in iron ore or raw metals, or even copper and maybe perhaps gold. And you can tell that the difference between metal commodities and energy commodities, there's a gap there since October. And I think that will probably persist here, especially if they do plan to do some level of fiscal spending that involves infrastructure spending.
And let me ask you, the Chinese stock market has been highly correlated with margin debt, and that has to do with leverage in the economy, and leverage can be expressed in different ways. We have support going to the property sector, but do you foresee a situation where we see a speculative bubble in Chinese stocks again, or is the Chinese government just kind of capping that and really limiting the private sector activity?
Doesn't seem to be any indication of that yet, like we've experienced in 2015. When they sort of infused that bubble and then deflated it again. So a bit different situation. I think it's really about the reopening of the China economy, that seems to be really triggering global activity. And as a result, it also then drives money back to Chinese companies, even though there's restrictions, being floated here in the United States with bills about, limiting investment in technology, or let's see, at least semiconductors. The investor climate is for China, I think, relatively positive. If you look at the breakdown of activity and reopening for China currently, it's a lot about international flights and about leisure and hospitality activity. So I think that is really the driver there that will also boost probably China's stocks and not bring the government back to that situation of capping down or clamping down on margin debt for Chinese stocks.
I want to zero in on tech just to finish this out here, because, of course, we have the U.S. expected to announce new measures that have to do with U.S. companies spending on technology in China, right? You have some talk about a ban on TikTok that still is persisting and floating around here in the U.S. China, for its part, also planning some measures about having to do with its tech industry. Should U.S. investors avoid China tech like the plague at this point?
It's a difficult question to answer, I think, Julie, because, yes, on the one hand, you should at least be careful. The crackdown on China tech is not fully over, and we don't know what that really means in that sense. It's very hard to get a handle on that from Chinese communique. On the other hand, it's clear that we're working on an executive order to limit investment in particularly semiconductors, a lot of restrictions on doing business with China tech companies on artificial intelligence. So that geopolitical tension there is there. And yet, if you look at, say, ETFs, very simple, the CQQ ETF that measures the China ETF, a tech ETF, that's outperforming our domestic technology. So it does indicate to me that there's spending money coming from the China government into Chinese companies that investors have taken on as the positive development. So I don't think you should fully avoid it. You got to be aware of the geopolitical environment around China tech and how it all relates to the US and Europe.
Yes, I have to think there remains considerable macroeconomic headwinds potentially to Chinese stocks. Thank you for your insights here. Ben Emmons, the New Edge Wealth Senior Portfolio Manager, Head of Fixed Income and Macro. Well, it's a busy week for investors with Fed Chair Jerome Powell's comments on tap, along with Friday's jobs report. Investors going to be tuning into these economic insights to find out clues on the Fed's path ahead. And Julie, so big week. I think it's going to be about the jobs, but focus is going to be on Powell's comments on Wednesday, the biannual Humphrey-Hawkins testimony instituted in the late 70s during the Volcker era when he was trying to quell inflation. I think those two time periods line up. There might be a little overlap or not. Anyway, the bottom line is I think this testimony is going to be very key to determining if he's happy with the current trajectory of economic data in the U.S. and if he thinks that financial conditions maybe have loosened a little bit, tightened too much, haven't gotten much pushback from him over the last few months on that front, but things could change?
Yeah, things could change. Although if you listen to the recent Fed speak, right, it seemed like they were sort of laying the groundwork and then he's going to come in and sort of
hammer the 50 basis points?
Yeah, I don't know. I don't think 50 basis points necessarily, but I think he's going to just come and confirm what we've been hearing from them. This is likely to be the last commentary we get from him publicly before the March 22nd meeting of the Federal Reserve, and so there's going to be a lot of attention paid. Just looking at some notes that we've gotten this morning in advance of his testimony, Krishna Guha over at Evercore ISI, among them, says, we think the Fed chair will open the door to a calibrated upward move in the estimated peak interest rate in March. If the next batch of data confirm the strength from January. He doesn't think that he'll fuel speculation of a 50 basis point move or turn, in Guha's words, max hawkish. Yeah. So still perhaps a measured tone will be coming from the Fed chair.
Here's what I think happens. I think we have two huge economic data points, which is first NFP, that's non-farm payrolls, is Friday, the big monthly jobs report, then CPI the week after. If those come in hot, I expect some kind of leaked op-ed, or not op-ed, excuse me, article in the Wall Street Journal.
Nick Timiraos article.
Exactly. I would expect that because that has been the Fed's MO in this rate hiking cycle. So why would they deviate from that? But that is if these reports come out hot. And if they don't, maybe stocks enjoy a little bit of a run up on that. So
maybe, but the recent data that we've gotten has definitely confirmed the heat, right? We got last week some of the ISM readings that showed higher prices paid components, i.e. higher inflation than the Fed might want to see. And if we get the February jobs report that follows in the heels of January, yes, the estimate is for job growth of 215,000 for February. But remember, we got 517,000, which was a blowout report by any measure in January. And so even 215,000, that's still a lot of jobs.
Historically, that is still above trend. Right. And wage growth, that is expected to come in at 0.3%. That comes even in line and maybe a little bit hotter depending on rounding. I think that's going to weigh on stocks. But I'll tell you what, for this matter, for the S&P 500 had a really nice rally in January. We're going to talk about this more, flagged off a little bit. I think it can resume because it's been able to withstand these incrementally bad news reports as they reflect increased Fed hawkishness. So if the market can withstand all of this added extra pressure without the 200-day in the S&P 500 cracking its moving average, I think that's something to be said for the stability of this market right now. But we got some key levels in play. Yeah,
and one more level just quickly to mention as well as that 4% level in the 10-year, right? And not just in the 10-year, but across the curve. It's come below 4% once again. So we'll be watching to see if either the Powell testimony or the jobs report pushes it significantly above that level once again. We'll be watching it. Speaking of prices, though, Tesla pumping the brakes on its U.S. prices again. The EV maker has reduced the price tag on its higher-end models, with the Model S now starting at $89,990. That is a 5.3% decrease. The Model X now starts at $99,990, a 9.1% drop. This comes after Tesla previously slashed prices in January. We're going to do a deeper dive into what this means for Elon Musk's auto giant, also maybe what it tells us about auto prices more generally. That's later in the show. And investors are facing a fresh dilemma in the markets amid incoming data. You can catch up on the latest in today's morning brief over at the Yahoo Finance homepage. For more on that, we bring in the author of that. That's Brian Sozzi. Soz, as we look at the outlook for the economy, which some people are saying it's going to tip into recession, and we're looking at earnings on the other hand, and earnings, they don't look so great. So we're kind of like, the market's a little bit in drifty mode here.
And that's the dilemma. And this was really something highlighted by a friend of the show, friend of our network, Keith Lerner over at Truist. He's writing this in his latest market outlook. The recent action is very much aligned with a key market dilemma we have been highlighting He goes on to say if the economy stays stronger, as we have seen recently, Fed policy is set to remain tighter, and this will weigh on market valuations. Of course, we've seen over the past month, as various Fed speakers have come out a little more hawkish than the market expected. Stocks do not like that. They will tend to trade down. Keith also brings this up. If the economy weakens, this will pressure corporate profits. To your point, Julie, neither of these are outcomes that are favorable for premium market valuations. And Jared, you're in the numbers guy here. You look at the valuation, forward price to earnings multiple on the S&P 500, 17.6 times above the 10-year average of 17.2 times, despite us being in the middle of a Fed tightening cycle.
Saz, what do you think happens with margins in the next earnings cycle here? Because there's been speculation that estimates should come down a lot more to meet what expected to be more compression in that area. And then there's other thoughts that we have a bifurcated market here, and you got some winners, you got some losers, and that's only going to expand over time. How do the averages look to you here?
Well, let me run my discounted cash flow analysis,
yes.
Jared. No, but really, it's weird because we are in a dilemma from the standpoint of margins, because if you hop onto these earnings calls over the past few weeks and you do get a sense of disinflation. Now, that is not deflation, that is just the rate of growth for many companies. They're seeing inflation start to come down, fuel prices, various commodities, but levels are still high. And then you stack that up against with the cost of credit likely continuing to go higher for a lot of these companies. All of that is negative for net profit margins, which is further down the line item from gross margins and operating margins. Not to get all geeky on you on Monday morning, it's just how people think about it.
That's the way we like to keep it on Monday morning. Nice and geeky.
And every day for that matter.
Yes. So Brian Sazi, thank you for stopping
Thanks for having
by
me on the
here. All right, let's continue with the market outlook as recent economic data has driven interest rates up, keeping equity markets very much on Fed watch. So for more, we welcome in Simeon Hyman. He is a ProShares global investment strategist. Simeon, always great to see you here. So you were just listening to Brian outlay some of his thinking from the morning brief here. Just what do you think of the upcoming earnings season, even though we haven't even closed the door on Q1 here?
Yeah, it's very interesting. People have gotten very worked up about the rise in interest rates over the last month, and they've gotten worked up over the incremental, the more and more inversion of the yield curve. But if you look a little bit more carefully, what you see is actually the yield curve got less inverted on a real basis. So what that means is that inflation expectations have stayed actually pretty stable on the long end. So that big jump in the 10-year, that actually dramatically increased real interest rates, and actually real rates are flat between the 2 and the 10s. So my takeaway from that is that the bond market isn't necessarily raising the scary recession and bad world that people think that it's indicating. And what that says for stocks is stable PEs, but if the near-term inflation numbers are going to stay sticky, that's the margin story that you were just referring to.
And so, Simeon, as you look at these, I mean, the way that Saz painted it sort of in his morning brief is that, like, you're sort of trying to sail through a very narrow passage that could lead to positive returns. Do you see it that way as well? And what does that situation look like?
Oh, that's absolutely right. You know, if you look at this pullback in the equity markets, common intuition says, oh, it was all about rising interest rates. Not at all. Q4 earnings season deteriorated from roughly flat year over year to minus 2% year over year as February unfolded, and it was a 2% pullback in the equity markets. So it really is all about earnings, and that 2% pullback is substantial margin compression because S&P 500 top line was about 5%. So you got to look for the companies that have some pricing power. We talk a lot about the S&P 500 dividend aristocrats. It's our ticker NOBL. Those companies with the same 5 or 6% top line actually increased earnings 11% year over year. So you got to show up with the pricing power, and you got to show up with some ability to fight off these rising costs that are going to be sticky for the next 12 to 24 months.
All right, so we just covered one market in particular, one ETF covering the dividend market. Just wondering, what other places should investors be looking for opportunity right now, and especially in light of some of the other economic data that we've gotten out over the last month?
Well, I think the other area of the market that folks should focus on are mid and small cap stocks, particularly mid cap stocks that have been so ignored. If you ignored mid-cap stocks for the last decade, you're a winner. We know what happened up until about 12 to 18 months ago with the run of large and mega cap stocks. But over the decades, mid-caps have been a big winner. And in fact, recently, so let's put it in context. After that 10-year run of underperformance, they're trading at about 50 cents on the dollar. Same with the Russell 2000, so both mid and small on sale. But if you look at those mid caps, they're actually generating in aggregate more earnings growth than the S&P 500. So that's a place that people shouldn't ignore.
Why is that happening, Simeon?
Well, I think what you've had is, number one, the price thing we know. So the price part is the run of super large cap tech, which has driven, outsized gains again up till about a year ago. But still that discount is there on the mid cap side. But if you look at what's going on with margins and earnings there, you have a little bit more of opportunity because of the domestic focus, because there's a little bit less tech and a little bit of a shift towards that service side. And we all know that it's the tale of two economies right now. ISM manufacturing, 47, that's the last reading. Contractionary services, 55, that's dramatically expansionary. So there's a little bit of a sector story in that mid-cap piece as well.
Makes sense, Simeon. Good to see you. Thanks a lot. ProShares Global Investment Strategist Simeon Hyman. Coming up, RH getting hit by a Jefferies downgrade. You can see down almost 2.5%. We'll discuss that. We'll also have the opening bell on Wall Street. That's coming up next. Plus, what does the VIX tell us about stocks? Jared's going to do a deeper dive later on in the show. Let's talk some movers now. Goldman Sachs out with a buy rating on Apple, along with a price target of $199, implying upside of over 30% from the stock's close on Friday. The share's moving up by nearly 2% today. And this is an initiation on the stock under a new analyst, Michael Ng. And it's the first time that Goldman's recommended buying Apple in about 6 years' time. It has to do with a lot of different factors that,
Yes.
that he lays out in his note initiating coverage. But part of it has to do with the strength in services. The gross profit from services should rise to 40% by fiscal 2027.
Yes, and it's all about their ecosystem. Here's a quote from the analyst. Apple's success in premier hardware design and resulting brand loyalty has led to a growing installed base of users. And so the company can increase its number of users, reduce the number of people leaving the ecosystem, so that gets to churn and all that other good stuff. Let me go to the Wi-Fi Interactive if I could here. I have a 2-year chart of Apple. Now, I got some candlesticks up here. Basically, Apple is in a downtrend. We can see here we got lower lows, lower highs. And I guess you could kind of draw a few different lines here as to where you might expect the breakout. But so either it's happened, it hasn't happened yet, but there hasn't been a lot of momentum since we reached this upper trend line here. So let me reduce these lines. My bottom line is above the current highs, let's say 160, 165, probably need to clear that. And then we got, I would say, a pretty sure thing test of those previous highs. Whether or not we go above, going to be difficult to say. A lot of these big stocks, Apple, arguably the greatest bellwether stock, maybe throw Tesla in there too, with respect to the U.S. equities market. If these stocks are not increasing, it's going to be difficult for the entire market to come along. They don't have to lead, but they have to be showing some good technical progress. And a lot of these are just kind of stalled out after those January highs.
Yeah, I mean, Apple, the technicals obviously are important. This note obviously is more digging into the fundamentals as well, which go hand in hand. And what you were talking about the ecosystem, when you look at Apple, and which is such a powerful tool for the company, the analyst here is saying that it's sort of almost been overlooked in this current period because the market is focusing on slower product revenue growth, and that the company has durability and visibility attached to that ecosystem and the sort of the growth that can come from being in that. Another thing that the analyst points out is that valuation is actually attractive relative to Apple's historic multiple, and that's not necessarily something that you can say of a lot of big tech right now because their earnings power is sort of not as strong as it was.
Yes, you can look at the multiples for a lot of companies have crashed, some harder than others. Meta, I think, crashed the most, but it's fortunate enough to have capitalized on short selling, short covering rally earlier in the year. With respect to Apple, big picture, I'm thinking out over the next decade. We've seen Google and Microsoft pivot to AI in a big way with ChatGPT, and I believe Google's Bard, but this is going to pervade everything, not only with respect to some of the more obvious moves that people are using it for now, like producing some interesting prose that we get to read, but also self-driving cars, autonomous vehicles. There's going to be something in here for everybody. Apple, I think the Apple Watch combined with AI and Apple focusing on health is going to be a huge winner. It's not obvious now, but the leaders in AI are being decided right now. The tech, as it is being unveiled to us in a very careful manner, I would say, with the tech out there right now, very much in its infancy and not a shadow of what is actually out there is what we're seeing.
Yeah, and Apple, recently reined in some of the ChatGPT apps on its App Store. It is not sort of as aggressively out there marketing itself as AI, but that's not unusual given what we've seen in the past with Apple product cycles. They like to be best rather than first. And they've got Siri, which actually is AI.
Well, yeah, all these digital assistants are based on AI. It's not like they're not here already.
Right.
This
it's
is just
a matter
talking
of the
about the
generation.
next level.
Yeah, exactly.
All right, so we got to talk about RH. Jefferies downgrading the maker of some of our favorite home furnishings here to a hold, citing the struggle in the luxury housing market, stabilization, and more risk versus reward heading into the company's quarterly results. So RH, this is a company stock. I'm trying to find it here on the Wi-Fi Interactive. If I don't, forgive me, but the housing market, suffice to say, got really hit by increasing rates. The housing market oftentimes gets hit in that proportional manner. And so we've seen that occur. In terms of the home builders, and let me just find this on the Wi-Fi Interactive. Here we go. If I can show a chart here, and here's what's happened year to date in some of our home improvement, and this is not apples to apples with everybody here, but you can see RH is up 11%. But in the context of what's happened over the last few years, you can see that big rise as people were furnishing their homes. Home Depot had a huge rise, so did Lowe's, home improvement, and then we got stuck by the reality that there's going to be a lot of wind taken out of the sails out of these multiples. So still languishing kind of in the bottom end of its range here.
Yeah, and this note specifically calls out not just the housing market, but investment banking bonuses and what's going on in the tech industry with some of the layoffs. So it says mid-level PE professionals that their bonuses are down 33%. So this is in the luxury slice of the furnishings market. And so that's why Jefferies is pinpointing RH as a source of concern here. There you got the opening bell on Wall Street today as we kick off this week after seeing a bit of a rebound in stocks last week. We are now seeing maybe that rebound could be continuing. We'll see what happens as we get underway here this morning. Obviously, we are potentially going to trade a little bit in a waiting game here earlier in the week. As we were talking about earlier, we are awaiting testimony from Fed Chair Jay Powell. We are awaiting the jobs report on Friday. And this opening bell is sponsored by Tasty Trade today as we look at these opening prices and see the Nasdaq leading the way, up by 0.4%. The Dow little changed here today, but we continue to see the outperformance of the Nasdaq on the year here. Jared, you're over at the Wi-Fi Interactive. What kind of action are you seeing as we get underway?
Yes, let's take a look at the S&P 500, up about 22 basis points there. But what I want to show, let me put a 6-month chart on our screen here. And here we can see we definitely are in an uptrend over the weekly to monthly time frames here that we're seeing on the chart. We came down, now not shown is a 200-day moving average. I kind of mentioned that before. We had this really big 2-day liftoff from it last week. And now we need to see, can this continue? Morgan Stanley worried Mike Wilson, out earlier today saying he thinks that this can continue. Now he still has concerns about the rally for its longer term prospects, but this was mainly, I would say, a tactical call saying that given the strength of the rebound off of this level here, probably got some room to run. So let's take a look inside the market and see what's happening on the sector level. And here we have communication services followed by tech. Those are the two big outperformers of the day, followed by real estate. That's also outperforming a little bit. Materials, energy, staples taking it on the chin here, but nothing getting hit too heavily. And inside the Nasdaq 100, looks like it's there we go. We got Apple up 2%. We were just talking about that analyst call. Goldman Sachs finally recommending this stock after a little bit of purgatory there. Meta up 1.7%. And it doesn't look like we have too many huge losers here. Let me take a look at the Dow, see what's trending there. Again, we got that Apple standing out, but nothing too dark or nothing too dark red or too dark green that we're looking at. Finally, just taking a look at our leaders board. Meme stocks, are they doing anything today? Quick look at the meme board. Let's see how it populates, and I'm guessing it's probably going to be mixed here. And indeed, Hertz up 6%, Ape shares, that's an AMC trade, that's up 5%. Not seeing a whole lot else out there.
Yeah, no, people maybe even holding off of their speculation until we hear from Jay Powell.
Well, that's a sign in and of itself.
Yeah, exactly, of what people are kind of waiting on as we head throughout the week. Let's talk about one other mover that we're watching, and that is Ciena, the telecom equipment maker. The shares moving up by 7% after the company blew past estimates in its latest quarter. It was driven by gradual improvement in supply chain and strong customer demand here. If you look at the EPS, I mean, when you talk about blowing away, look at that. I haven't seen a beat like that in a little while here. 64 cents versus the 36 cents that analysts had been anticipating. Networking platforms revenue up 36%. Converged packet optical revenue, whatever that means, up 36%. Routing and switching revenue, I know what that one means, is up 39%. So seeing some big double-digit gains in various lines of its business as it did get some of its supply chains back online.
Yeah, not a lot of for me to add to that analysis there, but looking at a chart on the Wi-Fi Interactive, I'm going back 5 years, so this predates the pandemic. We can see pretty steady uptrend into 2022, probably like many other companies, taking advantage of those low rates and also the stimulus money working its way through. Then we saw the huge crash. So it looks like pretty much following the cycle of a lot of other tech companies there and just trying to get its footing, rebounding late last year into the first part of this year. I'd say kind of textbook as to what's going on in the tech field right now for a lot of software and chip manufacturers. Yeah,
just one more stat to point out here from the quarter. Adjusted gross margin at 43.7%. It's still lower than a year ago, but analysts were only looking for 41.8%. So that's one of the other things powering the earnings. The stock was down about 34% last year. Unlike a lot of other companies in the tech and telecom space, it hasn't rebounded this year until today, until this earnings catalyst has pushed a little higher today.
Yeah, and also with these companies, the telecom field, it doesn't have that higher beta multiple, so you don't expect quite as much volatility. Although compared to the stocks in the S&P 500, it would still have a little bit elevated volatility. All right, coming up, Tesla is slashing its prices yet again. Praz Subramanian is back with the details. Up next. Welcome back. Tesla slashing prices in the U.S. Again, the EV maker posted a further price reduction on its website for its higher-end Model X and also the Model S after previously lowering prices in January. Yahoo Finance's Praz Subramanian joins us now. So Praz, kind of kick toward the competition here. They want to keep up their revenue targets, their growth targets, I would imagine, lower prices. What does this mean for Tesla?
Yeah, you know, with these top-end Model S and Model X vehicles, they've been sort of calibrating it, cutting it, raising prices a little bit, cutting again. You're actually pretty decent price cuts here for both those cars. So, you know, the Model S sedan, you're going to see that drop by as much as 5% for the base range model there, and then the Plaid goes down about 4% to 110,000. So you get that Model S regular for 90,000. You see the Model X SUVs there. That base version now at 99,900, and that Plaid at 110. So you know, that's a 9 to 8% drop there. So that's a pretty significant drop there for those cars. Now they don't really qualify for that IRA tax credit because they're above the price range for that. So, you know, that's a little kind of like nice little thing there for owners or buyers of those high-end cars, and helps it compete against the, you know, the Porsche Taycans of the world, the Mercedes EQSs of the world, and the upcoming BMW i7. So I think it's a nice way to kind of gin up demand. Musk said himself that, you know, there's not enough, there are enough people there to buy Teslas. They just don't have enough money to buy them, right, so to speak, he said in some sense.
I'm so curious though, because it makes sense if they're cutting the prices of the lower tier vehicles. At this price point, like, how price sensitive is somebody who's buying a $100,000 car? Like, does it matter? An 8% difference? Is that big of a swing for the? I don't know.
I mean, I think at 10%, that's your sales tax, right? That's a pretty big in my opinion, a pretty big cut in terms of, look, the competition is heating up at that high end, right? Like I said, the Mercedes EQS and Lucid Air is at that level too. So those are some actual cars that will compete nicely against a Model S and Model X. So I think that's why they want to, they're seeing that those demand drivers working at the lower end. Rich people aren't immune to price cuts, right? They don't want to pay money if they don't have to.
Economics happens at the margins, at the edges.
Yes, I guess
that's what
so.
they say.
Let's also move on to Ford, because you wrote a big story out on the Yahoo Finance homepage over the weekend where you talked about how much is riding on the company's EV strategy, right? And its restructuring of the company as it sort of not splits into 3 units, but the way it's organized is in 3 units.
Yeah, it's a big year for them. Q1 will be the first year they actually report the 3 subunits: Ford Commercial, Ford Model E, which is their electric division, and Ford Blue, which is standard ICE gas-powered cars. And Wall Street sort of applauded that move when they announced it last March. And since then, there have been some issues with production and things like that, and actually EV batteries. They're not the only company to have problems with EV batteries. So the spotlight's on Ford this quarter, right? To actually report how they're actually going to break out how much money does the EV unit lose, how much money does the ICE business make. Can they actually normalize it over the span of the next 2-3 years? A lot of focus there on Farley there for that, for CEO Jim Farley, I'm sorry. So it is a big deal for them, and they're the only automaker doing that right now. So maybe we'll see others do that, split the businesses, show how they're actually profit and loss sort of numbers there. But yeah, it's a big quarter for them, for Jim Farley and company.
And I was going to ask you whether there's any kind of optimism, like how do investors and analysts think he's going to be able to deliver? We were just showing the stock price chart. Doesn't look like there's a lot of optimism baked into that chart.
Yeah, I mean, they had a good week last week with some good numbers, some good news, but the stock is pretty much down half to what it was late 2021, mid 2021. It was like $25 a share. Now we're at 13, so still half what it was before. But yeah, I think there's optimism that in the next couple of years, you'll see that EV unit actually be profitable. I think Ford and GM both are saying that it's not gonna be right away that they're profitable. It's gonna take some time for them to actually get ramped up and make cars at parity with the ICE-powered cars.
Interesting. All right, we'll be watching them, of course. And we're also going to do a deeper dive into the state of the auto sector with Cars and Bids founder Doug DeMuro. That's coming in the next hour. Pross will be back for that combo, and you don't want to miss it. Coming up next, though, how corporate stock buybacks affect the market. Not all buybacks are created equal. We'll speak with Verity Data's Ben Silverman next. Let's talk volatility now. The market's so-called fear gauge is seeing a pullback. That should be good for stocks, but is it? Jared Blickery has the details. Jared, I hadn't heard the word Volmageddon in a little while.
Ooh.
And the words come back a little bit thus far this year, that there are a little bit concerns. But that chart doesn't look like Volmageddon is here.
Well, if my memory serves, I think that was 2018, and we could take a look at a longer-term chart. That was when there was a problem within the VIX. It exploded. Some ETNs that were related to it, the exchange-traded notes, kind of blew up, and that was a separate episode. What we see here, the VIX is at the lowest levels, slightly off of these lows that we have here, at least on an intraday basis, but basically at the lows of 1 year. And what we've seen is the VIX typically mean reverts. So it will go higher when it reaches the bottom end of the range, and it will go lower when it reaches the top end of the range. So if we take a look at a 3-year chart, we can really see this in effect. Now, a few years ago, it looked like we had a much higher level, and I think this is actually the VIX of the VIX. Well, let me see if I can get the regular VIX back up there. So this is a regular VIX, and we had a regime of lower volatility in 2021, raised a bit as we went through that bear market in 2022. So the question is, are we back into that lower volatility regime, or just basically continuing on the same lines as last year? Well, things could also be different this year. The bottom line is somewhere between here and here is a pretty big potential for a reversal to the upside. Also want to show you what the entire VIX futures curve is doing. You can bet on what the volatility is going to be at later dates in time. So this covers the spot or the current price of the VIX all the way out to November of 2023 of this year. So current line, that is a purple right here. And here's where it was a month ago, that cyan line on February 6th. So everything has shifted lower. And over that time period, we've seen the S&P 500 go through some gyrations, as well as the small caps. And we'll get to the small caps in a second. But let me just show you what has happened over the last few months with the S&P 500. We reached that low in October, and we've been trying to rally ever since. And now we've consolidated. I'm going to bring this down to a 9-month view. We've consolidated right above the 200-day moving average. To the upside, we got about 4150 to 4200. That is a potential resistance area. So until we break one of these two areas, still kind of in a consolidation area. Now, with respect to small caps, because those have been in the forefront of investors' attention this year, this is seasonality for small caps during March. The purple line goes back 20 years and covers every year. The cyan line covers every single pre-election year in the presidential cycle going back to 1950. So this will be 3 out of the 4-year presidential cycles. Suffice to say, both of these have stocks ending up for the month of March, and that is what typically happens in March. And as you'll see here, there's usually kind of a low or a nadir for the month in the 6th trading day. So we've probably entered that point right here. And if seasonality is carrying true, and we don't have outside factors, and of course we have a lot of outside factors, but seasonality alone suggests that there's clear sailing throughout the end of the month. So we'll have to see if that comes to pass, Julie.
A few outside factors, but yes, we'll see if that indeed comes to pass. Thanks, Jared. Let's talk buybacks now. Salesforce expanded its buyback authorization by $10 billion last week. Its share price surged higher on the heels of the announcement, though investors like Warren Buffett tout that buybacks are beneficial to shareholders only if made at value accretive prices. So the question is, are all buybacks created equally? And by the way, there are a lot of them this year. They're projected to top $1 trillion for the first time in a calendar year this year. Investment research firm Verity Data's Director of Research, Ben Silverman, joined us now to talk about this. Ben, it's good to see you. Thanks for being here. So when we talk about the different kinds of buybacks, right, let's talk about Salesforce first as an example, because the company said it was doing this buyback in part because of dilution from stock awards on the other hand. So talk us through kind of the technicals of that and what it means.
Thanks for having me, Julie. Yeah, so Salesforce's buyback was an interesting one because Mark Benioff was very frank about it. The whole purpose of the buyback is to offset stock-based compensation expense. And at the company, if we look at Q3, because they haven't issued their Q4 10K yet, that expense increased 22%, in the 9 months ended October last year. So their stock-based comp expense is rising, and their stock-based comp, they're still issuing a lot. So they're just using it to, knock that out. They're not in the end, your net share count is not going to reduce year over year because of that. And, they're not talking about being opportunistic with it. They're just talking about buying back stock to simply, offset that dilution.
Well, and when we listen to certain political rhetoric from various members of Congress talking about it, you can get different points of view. Specifically, I'm thinking of Elizabeth Warren, who kind of has a blanket approach to buybacks, which is all of them are bad. Just wondering what happens with legislation in the U.S. if there were to be more of a concerted pushback against buybacks on the legislative agenda. What would that mean for corporations and in terms of their planning as well?
Well, there's certainly already been some pushback. We have the 1% buyback tax this year, which is new. That doesn't seem to be deterring, managers from executing buybacks. It's just simply the cost of doing business. There's a proposal out to, push that to 4%. It's certain that, the Republicans are not going to, back that whatsoever. They've been very vocal about not backing any tax on buybacks. I think, it's one of these issues that it's hard to resonate on Main Street with this issue because most people, including a lot of investors, don't know anything about buybacks and what they mean. Politicians are, seizing this because, it's an easy connection to make to say that buybacks, help increase executive compensation, and line the pockets of shareholders. Well, we want shareholders' pockets lined. For me, the question is not so much politically, it's just, from a business perspective, are companies being smart about it? Are they making it a reasonable part of their capital allocation plan? So that, that's the big thing. And that gets missed in the political rhetoric.
When investors are trying to figure out if it's a good buyback or not as helpful buyback, right? Warren Buffett, as we mentioned, he talked about buybacks and the quality of buybacks in his investor letter. And he said, when you're told all repurchases are harmful to shareholders of the country or particularly beneficial to CEOs, you are listening to either an economic illiterate or a silver-tongued demagogue. And he made it clear that he thinks that if they are value accretive, then they are helpful. How do I, as just an everyday investor, figure out if they're value accretive?
Well, this is what we work with our clients on, is we're trying to help them identify companies that are buying back at good prices. And one of the funny things about buybacks in the financial media is that there's a lot of coverage around the plan announcements, with Salesforce being a good example. The company announced the $10 billion buyback plan expansion. What is not covered as well, and is ignored a lot by sell-side analysts as well, is the actual execution of the buyback. And the sterling example in recent years is Meta Platform. There was a lot of positive buzz when the company announced their first buyback program several years ago, added expansions to that. But if we look, since 2017, the company's bought back almost $100 billion of stock. The stock is still down. The stock is down 30% from that average buyback price. So they did not do a good job of repatriating capital, at a good price. For investors, what's really important is listen to what management is saying. We track insider transactions, and so that's what management's doing. Buybacks, you can look at what management's doing. Also, listen to what they're saying. Are they even talking about buybacks on their conference call? You were all just doing a segment on Ford. Ford announced a buyback last year. They haven't mentioned it since. They started to do some execution in Q4, but it never comes up. They don't talk about it as part of their capital allocation strategy. That signals to me that it's not important to them.
Very interesting. So investors should watch not just the actual dollars and cents, but then the execution of the buybacks as well. Great point here. Ben, thanks for being here. Appreciate it. Important topic. Ben Silverman, Verity Data Director of Research. Thank you. Coming up, is it time to get bullish on natural gas, and how? We bring in you Yahoo Finance's trending tickers, and one you might not have heard of. I hadn't. We'll be right back. When I came in this morning and looked at the trending tickers list, as I frequently do, there was a name I didn't recognize. BOIL is the ticker, the ProShares Ultra Bloomberg Natural Gas ETF. It measures the price performance of natural gas reflected through futures contracts, and it's been a big target for investors, or had been a big target for investors seeking a bounce back as natural gas prices have dropped 34% since the start of the year. Jared, what's so interesting here, so this thing was on fire, and then it has come down a lot and has seen a lot of outflows from this ETF kind of going into last week, and you can see that the thing is now down quite a bit year to date.
Yeah, natural gas, there's a reason they call this the widowmaker in the futures industry, and this is amid an industry that is already used to high volatility. So not surprised to see that there. I think in terms of the bigger picture, why are we seeing certain ETFs more popular than others? I think there are two trends here. First is low to no fees. That's one trend, and investors have really started taking notice of that. And the other is these leveraged ETF, even single stock ETFs. So you can bet on the reverse. You can bet on Tesla going up by a multiple of itself or going down. So with that leverage, people are looking for juice because we haven't seen in the overall market, we haven't seen in meme stocks, the tremendous volatility that we saw in 2021, 2022, at least volatility going the right way for buyers of some of these stocks. So I think people looking for leverage are just using this as a replacement for wherever the action is.
Interesting. Well, I don't know if it's working for them or not. I guess.
Well, you know, if one is not working for you, there's always an inverse.
Right. So. Yes, that is true. Although, like, as a former colleague of mine used to say, like, you know, you have sort of green, yellow, and red maybe when you look at ETFs. Mm-hmm. And these require a higher degree of sophistication to trade these kinds of things.
And there are tax consequences with certain ETNs that you don't have ETFs. Read your perspective.
Yeah, you got to be careful. You got to be careful.
All right, coming up, what did the Main Street investor make of the wild February market? Data from TD Ameritrade this morning breaks it down for us, and that is coming up next.
Welcome back to Yahoo Finance. I'm Julie Hyman with Jared Blickery today in for Brad Smith. And we've got some breaking economic data right now. And this is factory orders from the month of January falling 1.6%, but that's actually not as big a drop as the 1.8% that was estimated. Ex-transportation up 1.2%. We're also getting durable goods, a January final reading, which fell in line with the earlier reading, 4.5%. That's also the reading from December. So continuing to see declines there. And Jared, this is kind of a piece with this narrative that has emerged that we are not buying as much stuff, right? That we are seeing some of the durable goods, manufacturing side of the economy that's not doing as well, but the spending has shifted to services.
Yes, I think that is definitely the trend. And these are not top tier reports, at least in terms of breaking news. Market moving reports. We're going to get that more with the jobs data later this week, starting on Wednesday with some preliminary estimates in various forms. Bottom line, economic surprise is really what I've focused on, and those have increased over the last, we've seen those increase in general this year. And so kind of interesting to think about that in terms of the hot economic data that we've gotten, both on some of the good side, what we would consider, retail sales, companies selling more stuff and selling more services, and then on the bad side with the hot inflation data. So
yeah.
The yin and the yang playing out here.
We were all waiting for the supply chain stuff to solve itself, and it's mostly solved itself, and people don't want to buy the stuff anymore. Or at least
and
not as much
and now
of
there's
it.
all this overhanging secondary effects. So
yeah, exactly. So we'll keep monitoring that and the sort of more market-moving data that's coming out later in the week. In the meantime, for the first time since September 2022, TD Ameritrade clients returned to net buying of equities in February. That's according to their latest investor movement index. And here to break down all the buys and sells of a volatile February is Sean Cruz, TD Ameritrade's head trading strategist. And he's in studio with us, which is always fun. Good to see you, Sean.
It's great. I just said it beats my kitchen as the background. So great to be back in studio.
Yeah, it's always good to see you all in person. So a return to net buying of equities. What does that tell you? What do you think was driving that?
So I think we actually saw a little bit of a turn in sentiment where clients were willing to step out and take on a little bit more risk. And what the return to net buying means that there's probably a little bit of follow through here. And I think everyone was trying to wonder, where are we going to start to settle? We've been in a little bit of this range where we feel pretty good about inflation, rates back off a little bit, markets rally, then we get a little bit of a scare. Rates rise again, markets back off, and we were in a little bit of a range there. And everyone's wondering, are we going to break out to the higher? Are we actually maybe going to pull back and maybe even test some of those lows we saw in 2022? I think seeing this right now shows that there is the potential for a very solid base forming at these levels we're at right now.
Yeah, and I think that's important to note, too, that we've seen a lot of strength in this market overall in the fact that it hasn't gone down as much on bad news. I think that's inherently a tell of a strong market. Nevertheless, we haven't seen it been able to break to new highs. And one of the scenarios that I've talked about with various guests on these programs is we have to be prepared potentially for a sideways market, which continues to frustrate investors on both sides. So you get these breakouts to the upside, suddenly reverse to the downside. These big down days that don't have any follow through. In general, what's your take in terms of sentiment and volatility? What should investors expect to navigate the market this year?
So, unfortunately, I think they should expect that market you just described, at least here in the near term. We're trying to figure out, one, where are we going to peak out on that terminal rate for FOMC? And right now, the market is still trying to figure out what that is. If you think about it, everyone was pretty much settled on that 5 to 5.25%. Now I think it's sitting right up there closer to maybe 5.5%. So we're going to need to get, I think, a little bit more consensus and agreement and stability on what those expectations will be. I also think if looking at our sentiment, we actually do a little bit more of a survey-based poll of our investors. And one thing we saw was they actually think we already were in some sort of a recession in 2022. Some think there might be another one coming here in the second quarter of this year. So I think that might be the two big things investors are focused on is where are rates going to peak out at, and are we going to get a recession? What kind of recession are we going to get if we do get one? In the past couple of weeks, we've gone from the no landing narrative that everyone was talking about. Maybe we're actually going to be able to sail through this and sort of thread the needle to, all right, well, no, maybe we are going to get one, but not too bad. I think those are the items that are just going to drive this volatility for the market. And unfortunately, it's just going to take time for us to get through this year and see how that data actually lands.
I'm also curious to dig in a little bit on what people were buying and selling on the platform, right? Because in the buy list, net buyers of Tesla, Microsoft, Alphabet, Amazon, and 3M. Now, one of these names is not like the others. Like, what's up with 3M?
You know what? I was hoping you were going to ask me that, because I saw that and I looked at that, and that was the one that just popped out. I was like, oh, all right, I see what's.
Right, I mean, the other ones are pretty classic, like retail investor names, right? Yes. And then maybe 3M reported, and people, I don't know.
So one thing we do see in a range-bound market, and to me, what confirms that clients are expecting the market to trade in a little bit more of a range or trade sideways, is they buy on weakness and they sell on strength. And we've actually seen that show up quite a bit. The 3M trade, the one sort of variable out there that maybe is a big unknown of how it will be. We got a little bit of a look at that over the weekend, is China. And whenever you start to see a massive economy like China come on, you immediately start thinking about industrials and energy as a part of that. And I think 3M is sort of one of those big industrial names that people like to think about when they think of a major economy coming back online. I think what we heard from China over the weekend was a little bit disappointing in terms of that growth estimate coming out around 5%. That means maybe they're not going to be as aggressive with trying to stimulate the economy. That might put a little bit of water on the story that maybe would help a company like 3M. But I do think some of the other tech names that's consistent with VIX down here where it's at, it shows that there's just a lot of risk appetite starting to form right now. And it makes sense you're going to go into some of those tech names that really got hit hard over the past year.
Got a question about the bond market. We got the 10-year hovering, kind of flirting with 4%, where it jumped above, then it jumped below. And so with all of this, after bonds had an absolutely horrific last year, 2022, any interest maybe in investors exploring TLT, some of these other tickers that can give investors exposure to the Treasury market in the U.S.?
So it's been an interesting year in terms of discussions I've had to have. I think for pretty much the entire decade leading up to this year, when people ask about retail and fixed income, I could just simply say no one really cares. Yes. In the past year, that has significantly changed. So not only are they looking at some of these exchange-traded products, some are actually going in and actually buying fixed income. It's something, a conversation.
Not just through ETFs,
not just
but
through
straight
ETFs.
up.
Straight up and it's a conversation I've been having with our fixed income traders quite a bit. And hey, where are you seeing some of the interest and activity? And it actually breaks out, I think, in terms of one, where are they going out in terms of time? So on treasuries, we're seeing a lot of interest at the front of that curve, right around 2 years, sometimes as far down as 3 months. They're just going out there taking advantage of that yield. When they look at corporates, they're still staying in investment grade, but they're going out to that 5 to 10 year tenor. So I think it's interesting in that they are going in and actually buying the actual bonds themselves, but they're going out into different tenors, I would say, when you look at treasuries versus the corporate space.
I want to linger on that for a second, because like for people who have been in this industry for a while, it's hard to overstate how unusual that is. For retail investors to be buying fixed income directly or through, I mean, the ETF industry didn't exist the last time we had yields at these levels that made people want to buy it. Yeah. But like, have you ever seen anything like that?
No, that was a big change we started to see take shape last year. And we started peeling back the layers of, okay, we used to just look at it as one, are they buying fixed income or are they not? But it started to become such a noticeable trend that we started segmenting it out, taking a little bit of a look about what they're buying, where and when. I do think it's going to be interesting now because we started to see this show up mid-year last year. So some of these bills and some of these other instruments might be coming due here in the coming months. It'll be interesting to see if they roll that over and stay in there, or if they take that, say, okay, you know what? I picked up my 3, 4, 5%, whatever it might be. I rode out the storm that we've had over the past couple of months. Now I'm going to actually put that back to work in equities. So I think it is going to be interesting to see where that pile of money, if it stays in fixed income or if they decide to put it back to work in equities. That to me would be the biggest tell of where their long run expectations are, just in terms of, do they think the worst is behind us and now they're ready to get back in and ride it out for the long haul, or if they still think there's a little bit more turbulence to come and they want to stay out of equities in mass for the time being.
Interesting. Or they just want to keep a little bit in there just in case.
I got 5 more follow-up questions on that. So really fascinating stuff there about the individuals buying bonds.
You can get investment grade corporates right now that are giving you 6 or 7% yield, which I think is something that you would not historically have seen. You'd have to go pretty far out in the risk curve to something that had a legitimate risk of default to get 6 or 7% in some cases in years past. But now you can get that in the investment grade space for fixed income.
I think you can probably sneak another one of those in.
Yes.
You want to grab one of those?
And how are you acting as custodian? Are these individual QSEPs that investors are buying? Are they going through Treasury Direct? Just wondering where the information...
mechanics of how they're buying it.
The mechanics of how they're buying it.
So one thing really funny, we had a conversation, we were joking around about how probably a year ago, no one had ever heard of Treasury Direct. But now everyone has.
This guy probably did.
Everyone has though, because the big I-bond story last year, and that just shows that. So now everyone knows what Treasury Direct is. We were just making a joke. There were actually memes about it, is how it came up. But we're actually we service custodian. It's the actual QSIPs, and those are purchased and held through us.
Really, really fascinating right there. So
yeah, most definitely. Sean, thanks for being here. Really good to see you in person too. Sean Cruz, TD Ameritrade head trading strategist, talking equities, bonds, everything in between. Coming up, our next guest is Autofocus YouTube channel has over 4 million subscribers. There he is. What are the biggest questions he's answering on the sector right now? We're going to ask him. We're going to find out next.
Fed testimony, quarterly earnings, and the monthly jobs report. It's a busy week ahead. Here's what you need to know. Fed Chair Jerome Powell will deliver his semi-annual policy report to Congress. Powell speaks to the Senate on Tuesday and to the House on Wednesday. Expect some fireworks. Both political parties have blasted the Fed's aggressive interest rate hikes. Powell has been critical of the standoff in Congress over raising the debt ceiling. There will be fresh economic data for the Fed to consider. The monthly jobs report is out Friday. About 200,000 jobs are expected to have been added during the month of February. The unemployment rate is forecast to stay at 3.4%, a more than 50-year low. Also in the coming week, watch out for earnings from Dick's Sporting Goods, Campbell's Soup, DocuSign, and The Gap.
Ahead of all of that we're looking for to affect the markets this week, let's do a quick check of the markets right now, sponsored by Tasty Trade. We've got all 3 major averages in the green at the moment. The Nasdaq is higher by 0.7%, so it's leading the way. And if you dig in on the sectors that are driving that action, it supports that. That is the XLK, that is the Infotech ETF, as well as communication services and financials. They are leading gains that we're seeing in today's session. Energy and materials lower on concern that China GDP target that we have been talking about of around 5% was a little bit lower than some China watchers were anticipating. Skipping the hard sell. The auto market might be seeing cooling sales, but petrol heads looking for their own quirky cars, gearheads are hoping to offload a car they're not using, are weighing their options in the used car market. Auto reviewer Doug DeMuro hoping to connect with those enthusiasts through his own auction website. And here to chat about autos is Doug. He's Cars and Bids founder, as well as Yahoo Finance's Pras Subramanian and Brian Sazi. And Pras, I'm going to toss it over to you.
Hey Doug, how you doing, man? It's Pras here, a huge fan of your work, man. You know, you went from the content creating side to actually owning your own business, your startup Cars and Bids. You raised $37 million recently. What's it been like moving over from the content side to the actually business VC side?
It's been harder than I expected, to be totally honest. There is a lot. I always tell people, if I had known it was going to be this difficult to run a business like this, I would have just started a podcast. I think it would have been a lot easier. But now that things are up and running and off to the races, it's gone reasonably well. And of course, we launched this business in June of 2020. We thought it was going to fail because it was COVID. But actually, we launched into the greatest car market in the history of the automobile. So it all worked out okay.
Doug, we're always talking about the quirks and features here in the stock market and the economy every day. Take us into your website and some of the data. What are you seeing in the used car market in terms of prices right now, based on the things you're selling?
You know, we mostly focus on enthusiast cars, but I think that enthusiast cars are sort of a reflection of the car market as a whole. Obviously, things have slowed down from their very peak, which felt to me like the end of 21, beginning of 22, maybe the spring of 22. That's kind of where things hit their top. But demand is still stronger than I was expecting. I was thinking, you know, as interest rates were rising throughout 22, cars would really start to slow down. People would start to maybe pull back on their purchase of these things. That hasn't really happened as much as I thought. Good stuff is still bringing good money, and people are still paying big money over sticker, as they call it, for really highly demanded new cars. So you're talking about stuff like Rivians and the latest sports cars that are coming out from various automakers.
So Doug, you know, speaking of that, we just saw Amelia Island wrap up this past weekend. I think they had a record amount of sales there. And I think kind of dovetails what you're saying. There's resiliency there that you're kind of surprised by. But also I've heard you talk about how some sellers on your platform maybe have unrealistic expectations. So is there sort of a balancing act there?
Yeah, I mean, I think there's no question that some cars have slowed down, and frankly, that most cars have come back a little bit from their peak. There are still a few enthusiast cars that are continuing to go up, and it seems like will continue to go up. But yeah, I mean, sellers come to us, we try to negotiate reserve prices with them. And sometimes they come to us asking, you know, using comps from 18 months ago, conveniently ignoring all the comps since 18 months ago that have kind of slowed down a little bit, and ask why we can't match those numbers anymore. And those numbers are definitely not where things are at this moment. But again, not as far back as I was expecting us to be when I started hearing a talk about rising interest rates, potential recession, that sort of thing.
So Doug, pivoting slightly to your first business, which was your YouTube channel, which I know a lot of fans we love the work, and it's you know, you maintain this sort of simple aesthetic of how you make your videos, and people like that. What's it like being a content creator these days? Are you so bullish on the YouTube game? Is it changing? Is it better?
That's a great question. It is definitely changing. There's no doubt that for a lot of reasons, I find that it's changing. But I think one of the biggest changes is the additional platforms that are coming on. You're seeing all these other platforms start to go after content creators. Facebook is paying big money to bring people. And of course, TikTok is on the forefront of everybody's minds right now. And I think that's going to fragment things. I always tell people who ask me, you know, how can I go and do what you did? I tell them to take a time machine back to 2013 and start YouTube then, because that seems to me that was sort of the heyday where it was the place to go to watch everything. And now stuff is starting to definitely fragment a little bit in terms of short form and creators going into other places and doing other things.
Doug, I was thinking back, I don't know, it was maybe a month or two ago, you broke down why prices for Teslas in the used car market are coming under pressure. What are you seeing now there, and what's next for that brand? We're coming off an investor day for Tesla. They didn't come out with a new model. They cut prices today. What's your outlook for a brand like that?
You know, it's interesting. When Tesla first came out with the Model S 10 years ago, believe it or not, it's been over 10 years ago now, it was so far ahead of everybody else that you couldn't catch up to Tesla. There was no possible way to catch up to Tesla. And in the ensuing 10 years, people have caught up to Tesla. And like you said, they haven't come out with a lot of new, exciting models recently. Tesla hasn't really shown us anything like they used to, where they could just drop something and wow everybody and stay years ahead. And it's just not quite like that as much anymore. And so I worry a little bit that the competitive advantage that Tesla had over the last 10 years has eroded fairly considerably. They no longer have the only electric cars with long range. They no longer have the only driver assist tech that can really do a great job of driving for you in a lot of situations. The Cybertruck, which has been touted and vaunted for years, is late. I mean, ultimately, Rivian is already out with a pickup. General Motors is out with a pickup. Ford has the Lightning. And so Tesla, it certainly doesn't have the same level of first mover advantage, I think, that it once did. But it's obviously still a very strong brand, and there's still an enormous amount of interest in it.
Who do you think Tesla's biggest competitor is, Doug? We're always comparing Tesla to Lucid, but Lucid's not really making any cars. Polestar is making cars, but they don't seem to compare with Tesla. Is it a GM? Is it a Ford that Tesla should be worried about?
That's a great question. I think it depends on the segment that you're in, and also I think it's just sort of some brands come out. I mean, Rivian will be a good competitor in the truck space, but they have nothing to compete with the Model 3. Yes, Polestar is competitive with the Model 3, but they have nothing to compete with, SUVs. Frankly, I think that the legacy brands are trying to figure out EV at a pace that they have never tried before, and I think that you will see those as the big Tesla competitors. I don't view Lucid as that big of a competitor. Like you said, they're not making or selling that many cars. But when you look at the Ford Mustang Mach-E, to me, that is a very competitive car with the Model Y. And I think that General Motors and Ford are very committed to an electric vehicle strategy that is going to make them continually kind of banging at Tesla's door over the next few years.
Hey, Doug, so maybe we'll see some EVs kind of come down the pipeline on the enthusiast modern classic kind of range there. But I wanted to ask you, I know you from time to time you do sort of your picks on what kind of cars might actually be a good investment down the line. I'm looking at some of my telling Sazi, I'm looking at a nice C6 Corvette, but I think I might have missed the market on that. What are some of the things you're looking at in terms of cars that might be under the radar, that might be decent investments down the line?
That's an interesting question. A lot of people ask me that, and it's difficult over the last year to really say anything because so many cars shot up so fast in 2021 that it's like hard to believe that anything is going to continue to grow. But I will say one segment that I will remain bullish on until probably years to come, analog cars that aren't, as the world moves to electric vehicles, which I think are great for most people for daily transportation, I do think there's going to be a huge segment of the enthusiast world that's going to wish to have cars with manual transmissions, cars that have a big engine sound, cars that still feel like kind of the old days. And I think analog cars that have those qualities are still going to continue to be desirable. A lot of those cars have shot up in value over the last 5-10 years, but I think they're going to continue to do so as more and more electric vehicles start to erode, any sort of engine sound and driving feel that we have in our daily drivers. Enthusiasts are going to seek those types of cars more for fun backroads driving.
I'm keeping my 91 Trans Am. If Doug said, I'm keeping. I'm not getting rid of that thing.
I was going to say, Doug, I think you're speaking to two of those enthusiasts here on set today. I saw Saz smiling very enthusiastically as you were talking. Thanks so much for doing this. Cars and Bids founder Doug DeMuro and Yahoo Finance's Prasad Subramanian and Brian Sazi. Thanks so much, guys. Appreciate it.
Thank you.
Coming up, U.S. lawmakers step up their push to ban TikTok and other China-based tech altogether. But what are you going to do on your phone all day if they do? We're in D.C. next.
Welcome back. A second Norfolk Southern train derails over the weekend. Lawmakers looking to raise the Social Security retirement age and a new bill to help ban TikTok. And for all of these things we're going to watch, we want to hear from Yahoo Finance contributor Kevin Cirilli. And we start with another derailment, this time over in Ohio. What is the latest on this situation?
Well, look, Norfolk Southern CEO Alan Shaw is going to be testifying on Thursday this week before the Senate. And already it's raised questions from Republicans and Democrats in the Senate, at least, who have been pushing for a bipartisan piece of legislation this Congress that President Biden has actually said he would sign into law. And what this piece of legislation would do is essentially put companies like Norfolk Southern on the hook for paying the cleanup costs for these toxic, hazardous materials that are frequently on these trains that are going all across the country. And should they derail, that these companies would have to pay for that. Now, Republicans in the House of Representatives, where they, of course, have control of the majority, are typically wary of doing this type of legislation and of getting the government so involved in this type of regulatory structure. You couple that with some of the political pressure that Transportation Secretary Pete Buttigieg has been facing, and it makes the regulatory outlook on this specific piece of legislation unknown.
And it's really interesting here. We spoke with the U.S. Transportation Secretary Pete Buttigieg about the first derailment, and here's what he said about that.
Well, EPA has already sent a letter notifying, in a formal way, notifying Norfolk Southern of its responsibilities. Obviously, I can't get ahead of an investigation that is active and ongoing, but Norfolk Southern will have to answer to EPA for the environmental side and to our department if there were any violations of rules that were found that emerged in the NTSB process.
And Buttigieg did later admit that his response to the first derailment maybe could have been different or better. So, what are we hearing about transportation's role?
Well, look, I mean, he's under a lot of pressure. This is a young, rising Democratic star, one time ran for president in 2020. And should there be an open primary in 2024, he likely would be one of the list of contenders who gets into the race. Former President Trump visited East Palestine in the last several weeks. He was very critical of Buttigieg, and Buttigieg has been engaging in Republican criticism of his own as it relates to this issue. He just did that over the last few days with CNN. And so, for Secretary Buttigieg, this becomes a defining moment in his current political, for his current political future. And so there's a lot of pressure facing Secretary Buttigieg politically on this. And I would anticipate in the Senate that you're going to hear some Republicans, keyword some, who are going to raise concerns about transportation's role during that hearing on Thursday.
And Kevin, how do you think Norfolk Southern and some of the other train operators are going to respond to these moves from D.C.?
Well, look, I think that President Biden has been clear that he would like to sign a piece of legislation that would force them to be a bit more transparent, but also to cover the costs. Because right now it's being relied upon the taxpayer to have to clean up these costs, and that's not, according to those who support this legislation, that shouldn't quite be the case.
All right. Also, Kevin, lawmakers are looking at raising the retirement age. Tons of repercussions here. And that would have Americans pay more in taxes for Social Security. What are some of the details here?
Yeah, our colleague at Yahoo, Ben Workshall, has done excellent reporting on this. And he has this story out on the Yahoo platform that really is a piece of bipartisanship, where you've got someone like Senator Chris Coons, a Democrat from Delaware, working with Republicans across the aisle to put forth a more financially transparent piece of legislation. They want to go back to snail mail because you've got a lot of retiring seniors who are getting a dizzying amount of information online about whether or not to access their retirement savings when they turn 62 years old. But if they wait a couple of years, they're actually going to be getting more money if they wait until they're 70 or in their early 70s to access that Social Security funds. And in fact, there was one study that found that for retiring senior citizens who do decide to offset accessing that retirement savings, they can earn something like $110,000 if more if they just choose to delay when they access their Social Security.
And finally, on a very different note, let's talk about TikTok, Kev. Facing action that maybe could lead to a broader ban by the U.S. This is something, obviously, that has been talked about in Washington for a little bit here.
Well, look, it's bad news for ByteDance. And I think that when you specifically look at the Senate Intelligence Committee chairman, Mark Warner, a Democrat from Virginia, he said to Fox News Sunday over the weekend that he is going to be working and releasing a piece of legislation this week with his Republican Senator co-sponsor, John Thune, a Republican from South Dakota. They're releasing this legislation that would make it much more difficult for ByteDance's TikTok and other apps who are rooted in foreign governments to be able to spread what they're calling propaganda here in the United States. Take a look at what Chairman Warner said. He said, quote, "They are taking data from Americans. They're not keeping it safe. But what worries me more with TikTok is that this can be a dangerous propaganda tool. We have never had a potential adversary like China. The Soviet Union was military or ideological. China is investing in economic areas. They have $500 billion in IP theft. And we are in a competition, not just on national security basis, but on a technology basis. And that's why he's pushing for these new national security laws. And again, we've reported on this, Julie, in the past. This is a rare bipartisan area that's really emerged in this Congress.
Yeah, it's a very interesting one to continue to follow. Thanks so much for doing that for us, Kevin. Kevin, it's really appreciate it.
Thank you.
Let's continue our conversation on the challenge for TikTok, the social media site under pressure for its ties to China. But is it so different from other social media platforms? Joining us with more Yahoo Finance's Dan Howley. So Dan, is it?
Well, Julie, it really depends. For the most part, no. I spoke to a number of experts in the cybersecurity space, and really, what it comes down to is this app is collecting similar data to Meta, to Twitter, to Snap, any social media platform, or most apps out there are collecting these huge amounts of data. For the average person, what does that mean for TikTok? Nothing really. The idea is that, well, as we just heard Senator Warner worrying about propaganda. Well, they kind of already do that on Facebook or Twitter as well. We frequently talk about these kinds of groups of bots that are found spreading propaganda from different groups. So sure, yeah, that could be an issue on TikTok, but it already is on Meta. The issue I think that a lot of people come down to is, where does the data go? And so, TikTok, they have a deal with Oracle right now where they're storing American user data in Virginia-based servers. Some are still in Singapore for backups, but they're shutting those down. And so when you talk to, or you hear politicians talk, they say, look, this data can be easily accessed by the Chinese government because the Chinese government can just force companies to do that. That's just part of doing business in China. But for the average American, that really doesn't mean much. There's fear that, sure, there could be, I guess, blackmail down the line. I think that the real information, though, is, easily scraped from other sites, publicly available information from your profile on Facebook or Instagram or Snap or Twitter. That's easily scraped by countries, and they would be able to pull the same kind of data that you would post on TikTok. If you're the type of person that's in a very sensitive position, though, someone like a political dissident or in a potentially protected group of people, then that's where the problem comes in, because TikTok can quite literally provide real-time breadcrumbs to your location for China. So that's just how apps work. Same thing with Facebook. But the fact that China has access to that means that they could easily track certain people. So for the average person, this really isn't that big of a deal. But for people who are in more sensitive protected groups or who are political dissidents, then that could be something to worry about. And you would think that knowing that China basically can get access to TikTok if they wanted to, well, you wouldn't use that app.
Dan, besides the whole data like sharing or selling or whatever access part of it, what about the research on the addictiveness of TikTok versus other apps? Do we have that information? I mean, when you look at, we've talked about this before, TikTok in China is regulated quite differently than it is here. For example, if you're under a certain age, you can't access it after a certain hour at night, right? It's just shut off. So what do we know about that aspect?
Yeah, and there are other laws like that in China that are seemingly, draconian, where, there's rules where, you can't play video games past a certain amount of time, depending on what age you are, regulating basically, societal behavior. But when it comes to the addictiveness of something like TikTok, comes down to their algorithm and what they have to offer. It's what people, companies want to try to emulate. We're seeing that from Meta. What they're doing with Reels right now. They're trying to emulate the TikTok algorithm. So clearly, there's a stickiness to it, we could say, that kind of supersedes whatever Meta or Twitter or Snap have to offer. And now they're coming through with Reels to try to emulate that. And, according to Meta, they're doing a good job of getting more and more people to use that service. So it looks like Meta is catching up. And so the addictive nature of them may be, parallel at some point.
And Dan, when we think about TikTok, it's a tech company, and a lot of the crackdown in China has been focused on those tech companies, always going back several years to the disappearance of Jack Ma, which I think was in 2020. Has that spread into other areas, and is that something that investors are concerned about?
Yeah, for TikTok, I don't necessarily think, that's going to be a broader issue. I think, they're very much following the government's kind of mandate, providing data if they're asked. If you ask people at TikTok, they'll tell you that, if U.S. user data has never been requested, and, frankly, they probably just don't want, my user data, right? I'm just a guy who's looking at cat videos and stuff. So they probably don't want that kind of information. I think it's not necessarily a problem for the broader company ByteDance, because in China, when they operate there, they'll turn over the data that's needed. So I don't think that that's going to be a problem for them now.
May your cat videos never present a problem for you in any way. Dan Halley, thanks so much for doing this. Coming up, the backlash against Walgreens escalates following its decision to not sell abortion pills in 20 states, despite it remaining legal in some of them. We're going to have the details next.
Consumer confidence decreasing for the second month in a row in February. The index falling to a 3-month low on worries over a possible recession. A decline entirely driven by expectations for the future. That means U.S. consumers keep feeling better about today and worse about tomorrow. We've got to talk about retailers, too. They're remaining cautious as inflation weighs on consumers.
We're just seeing a consumer that's making choices as they've seen the persistent inflation in a category like food and beverage, and that's taking a bigger piece of their share of wallet, and that's factoring into their purchase decisions.
I was at Costco this weekend, and let me tell you, those lines were incredible. As the consumer continues to gravitate and stick to those where value is everything for the consumer right now, they're looking for any way to save a penny.
Disinflation, like the Fed is out there talking about, is not necessarily happening. These companies are still dealing with high levels of inflation in their supply chain, and their customer base still dealing with high levels of inflation.
It's also a very bad macroeconomic situation right now where the consumers have shifted their spending. They're moving away from discretionary and sticking to staples. As a result, it's not the best scenario for the department stores in 2023.
I think the premium, the wealthier consumers are still doing well, and they're still pricing up, so to speak. Whereas the middle income and lower income consumers are not only scaling back some of their purchasing, but some of the features, some of the add-ons, some of the more premium components of leisure spend are beginning to tail off.
Walgreens says it will not be selling abortion pills in some states where it remains legal. That's after several Republican attorneys general threatened legal action. Yahoo Finance's Anjali Kamlani has the details. So Anj, this is an interesting new sort of frontier in this fight.
It is, for several reasons. First of all, it is Walgreens taking a stance in a political space which is interesting for a company that is really looking to get more into clinical services and medical services. We know that the Walgreens strategy is to get into more of a medical space. So that's really interesting in terms of, I don't know, customer building, brand building. But so what's going on right now is Walgreens saying that it won't be selling in 20 states by mail order. And that includes some states, like you mentioned, where it is legal still, the pills are still legal, and that's mifepristone specifically. And that's one of the 2 pills commonly used for abortion. So about, I think, 4 states, including Alaska, Iowa, Kansas, and Montana, are part of that, where the attorneys general are asking Walgreens not to sell by mail order. And this comes after the FDA opened up the ability for this pill to be sold by mail order and in more brick and mortar places. Until January, it had really been restricted to certain clinical areas like Planned Parenthood and that type of clinical services. So it's a completely different ballgame. All the other pharmacies are also facing the same pressure and the same line. CVS has not yet responded. Walgreens did not respond to a request for comment from Yahoo Finance. So we're gonna just have to wait and see whether or not they actually pull back on this stance. There have been a number of Congress leaders asking for Walgreens to change their mind and or calling for a ban or a boycott altogether. So it's going to be pretty interesting to see how this all pans out.
Yeah, it definitely will. I mean, it sounds like from what you're saying that people who still want access to these pills in these states still have avenues for that access at other pharmacies for now.
For now, and it depends on some, because the FDA rule that changed in January asks for these pharmacies to request access. So they have to basically get clearance from the FDA to start selling them and notify where they're going to be selling them as well. So it's going to.
So they haven't done that yet.
They're in the process of that right now.
And Walgreens has said it's not going to do that.
Has told these attorneys general that they're not going to, and that they're going to be doing it in some of the other states. We don't know the names of those states yet, so it's it's still a developing story, if you will.
Yes,
That's the best
definitely.
way. That's the best way to kind of describe it right now. We still don't know which of the other pharmacies like Walmart, Target, Rite Aid, where they're going to be selling as well. Also, the other sort of mail order pharmacies that are online, right? Ways that you get access. Amazon's now in the pharmacy space. What are they doing? So there are a lot of questions still about how this all plays out.
Well, and there's a lot of questions about why Walgreens has made this decision as well. Was it under threat of lawsuit? Speaking of threats, the way I found out about this story was on social media because someone I followed was calling for a boycott. So you have to wonder, I don't know if there's a way to sort of measure it in a quantitative fashion, how much steam that is gaining and what effect it could have.
Right, and the lawsuits are already happening, right? We're still waiting for Texas to come out with their rule on whether or not it can be available by mail order. We've also seen a couple other states like North Carolina and West Virginia, lawsuits there. So it's all playing out. This all following the overturning of Roe v. Wade. So this is the fallout of that right now that we're sort of witnessing live as it develops.
Yes, and when you see a consumer staples company take a big political stand, that's something you see every day there. So thank you for that report. And we'll be talking to you about this in the days and weeks to come. Yahoo Finance's Anjali Khemlani. All right, coming up, a crypto crackdown as security scrutiny rises over Binance. There's fresh reporting that the exchange developed a plan to avoid prosecution by U.S. authorities. Full story on that up next. Crypto exchange giant Binance in focus this morning following a report from the Wall Street Journal that amid the fear of prosecution, Binance had set out on a plan to neutralize U.S. authorities. Yahoo Finance's David Hollerith has more on this story, joins us now. David, what are some of the details here?
Yeah, so Jared, just to take a step back, so Binance International is the world's largest crypto exchange, and Binance US is a much smaller US regulated crypto exchange. There's been a long-running discussion about the relationship between these two firms, and that's become notably a bigger deal. As critics have pointed out, since FTX has collapsed, there are a lot of similarities in terms of structure between the two firms. Things reached a new boiling point on Friday, actually in bankruptcy court. Voyager Digital is trying to sell its assets to Binance US. And notably, the SEC, the FTC, and several state securities regulators have actively been objecting, and sort of the bankruptcy court is trying to go through all this. So Binance US licenses the Binance brand and technologies, but is technically a separate legal entity, though it's nonetheless majority owned by Binance's founder and CEO, CZ. As far back as 2020, there's actually been reports about sort of a connection to this, and even documents that have shown that Binance, at least at one point in time, was thinking about trying to find a way to reach US investors without having to deal with US regulators. So the Wall Street Journal story from the weekend drew from chat logs from Binance employees, and this provided further evidence that Binance for some time has been potentially trying to find ways to use Binance US to reach US investors without having to deal with regulators. Reuters has also reported about this extensively, and they've also drawn, as was in the Journal story, they've drawn a connection to Merit Peak, which was once a market maker for Binance US, and is also owned by CZ, Binance's CEO. But notably from this story, I think what was pointed out was the fact that the SEC chair, Gary Gensler, was actually being recruited by Binance before he was chair of the agency, when he was an MIT professor. And that's notable, as if we are to believe the chat logs from Binance employees, it indicated that he was generous in offering licensing strategies to the companies. Obviously, this licensing agreement situation is the legal connection between the two firms. It's also notable, as on Friday, CZ, the founder, actually did a Twitter Spaces AMA, and he sort of brought some of this to the public's attention too, saying that he had met and previously known Gary Gensler, and that they had had a good rapport, and he'd lectured for his MIT course. So this all just makes the connection between what's going on right now with Binance US and the SEC that much more interesting.
It does. And speaking of connections, I mean, as we talk about the interconnectedness of this crypto world, as we know, one of the potential casualties that you've been watching is Silvergate. What can we expect to happen next with that sort of crypto-focused bank?
Yeah, Julie, so for Q4, Silvergate fell into a situation which is they were less than well capitalized, or sort of on the brink of being less than well capitalized. There's a leverage ratio that is watched closely by banking regulators. And Silvergate was about 5.3%. Anything below 5% is a concern for regulators. And since then, Silvergate's come out saying they're going to be late on their annual report. Losses look worse. And obviously last week we saw the stock collapse by half between Thursday and Friday. So in this scenario, Silvergate's it's a bank. It's a state chartered bank. And so it could go into something which is receivership, which for banks, it's kind of like bankruptcy, not quite the same thing. And this would be decided by either the California state regulator or the FDIC. And in either situation, it would likely be the FDIC that would sort of take the mantle there. So we'll be watching that. But again, that's a worst case scenario. and Silvergate has fallen. It's lost so many deposits in the last couple of days. We are definitely expecting something like this to happen.
Yeah, most definitely. We'll count on you to keep watching it. Thanks so much, David. Appreciate it. Coming up, we've got some big interviews coming up today. We're going to tell you what to watch next. We've got some big interviews coming up today, including a conversation with Scout Motors CEO on the company's latest EV push.
All right, we've also got an interview with the CEO of Farmbox RX coming up in the next hour, a healthcare company focused on delivering food as medicine.
Plus, stay tuned for our 3 to 5 p.m. show with Shauna Smith and Dave Briggs. They're going to talk to the CEO of BetMGM. That should be an interesting conversation about sports betting right now. We're going to get into all those big interviews later in the day, but Rochelle Akufo has you for the next hour of trading as we see markets in the green. Jared and I are going to be back tomorrow for you.
Back.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this morning. Stocks find their stride after China's modest growth target raised concerns over demand. We break down the impact on commodities and whether or not this is a big win in the battle against more inflation. And no shortage of events for investors to focus on this week. Jay Powell's two-day congressional testimony will be watched closely for signs of fresh hawkishness. That, of course, ahead of another big jobs report this week. And taking a look at Tesla, those shares have been on a tear lately, but what's the impact on some of its biggest competitors? We'll also catch up with VW-backed player Scout as it plans big moves in the space. But first, let's check in on the major indices an hour and a half into the trading day. We see that it has been a bit of an oscillating day here for the major indices, but in positive territory. We see the Dow here up about 100 points on the day, the S&P 500 up about 24 points, the Nasdaq also with gains there of almost 1% on the day, up 111 points. Well, let's check in on the Treasury market. We did see last week the 10-year hit that 4% mark, seeing a pullback though as we kick off the week. We see the 5-year down slightly, about 1/3%, the 10-year down about 0.5%, and the longer-term 30-year yield down about 0.5% as well. All right, well, let's take a look at that week ahead. We know the Fed Chair Jay Powell's two-day congressional testimony will be watched for signs of more hawkishness. This as other Fed voices suggest rates are set to go higher for longer. Here with more, Yahoo Finance's Jennifer Schonberger. Hey, Jennifer.
Good morning, Rochelle. Fed Chair Powell heads to Capitol Hill Tuesday in the first of his 2 days of semi-annual testimony to Congress on monetary policy, where he's expected to talk tough on inflation and reiterate that ongoing increases in interest rates are needed. The Fed chair isn't likely to commit to any particular policy stance, but warned that as he did in February, that if we continue to get higher inflation reports or jobs reports that are stronger than expected, the Fed may need to raise rates more than what's been priced in by investors. Friday will bring a fresh look at the jobs market with the February employment report. More rate hikes that could cause job losses could draw rebuke from progressives like Senator Elizabeth Warren, who has taken Fed Chair Powell to task in the past that rate hikes could hurt the job market and cause a recession. Tuesday, Powell testifies before the Senate Banking Committee. Wednesday, Powell will testify before the House Financial Services Committee, his first time since Republicans took the House. Now, Powell's comments, likely his last before the central bank's policy meeting March 21st and 22nd, will come after a number of Fed officials have warned that rates may need to be raised higher than the 5 to 5.25% the Fed is currently projecting. Hawkish rhetoric from Fed speakers continued over the weekend, meanwhile, with San Francisco Fed President Mary Daly, the latest to warn that inflation remains too high. Speaking at Princeton University Saturday, Daly said bumpy progress on lowering inflation will likely require further rate hikes that are held at higher levels for longer. She said, quote, "The work is far from done." Meanwhile, across the pond, European Central Bank President Christine Lagarde called inflation a, quote, monster that needs to be knocked on its head. She said that further rate hikes are likely, inflation running at about 8.5% in Europe. Rochelle?
All right, thank you very much, Jennifer, for that update. Interesting because we know that inflation, of course, they had a milder winter there with energy prices, so still a tough time for Europe as well. All right, coming in like a lion. Indeed. Coming in like a lion, investors hoping for March's traditional trend to strength may be watching the Friday jobs report for a boost for that thesis, or to temper expectations perhaps. Joining us with a view on fundamentals, Thomas Hayes, Chairman and Managing Member at Great Hill Capital. Always good to see you, Thomas. We know this has already been a very roller coaster year because obviously they were stocks off to the races in January, disappointed in February. Now March really sort of circling the drain here, figuring out what's going to happen, especially with this big jobs data that's coming out. What are some of the market catalysts that you're going to be honing in on for March?
Well, there's a lot of pessimism coming in. We just went through the normal February week seasonality, Rochelle, and great to be with you, by the way. But there are three key myths out there right now that are keeping people out of stocks, and I think at the exactly wrong time. First and foremost is stocks don't go up during tightening cycles, aka don't fight the Fed. How many times have we heard that? But if you look back over the last 4 tightening cycles since 1994, the stock market is up on average 7.8% during the tightening period. And another myth within that is that tech can't outperform, but if you look at the data, tech and REITs are actually 2 of the top performers during those periods. The second myth that's been out there is that the stock market must go down when earnings are coming down. And history actually doesn't support that. Since 1930, in years where earnings are up year on year, the S&P does about 10.2%, including dividends. And in years that earnings are down year on year, the S&P does 9.8%. So the key is not timing the market, it's time in the market. And the final myth, and this is the big one, Rochelle, I'm sure you're hearing it all the time, you can't be in stocks with super high inflation. However, in periods of rising inflation, the S&P goes up on average 5.5%, so not so great. But in periods of falling inflation, the equity indices go up on average 14.7%. And I don't know about you, I don't need a magnifying glass to see since last July, inflation has come down every single month. We're in a falling inflation environment.
And Thomas, it's hard. I mean, these are some very well-established myths. And when you think about the fact that this really isn't your typical period when you think of a recession, this is a Fed-led recession. And so people trying to sort of balance what they know from history with their usual market expectations. So what should people be doing differently from the crowd? Where do you see the opportunities?
Well, I think they should be like George Costanza from Seinfeld and do the opposite. If you remember, everything started working well for when he went against his normal instinct. And what's the instinct? What is the crowd doing right now? Well, we see from data that equity flows out of equity funds have been the highest in the last few weeks since spring of 2020. And to jog everyone's memory, spring of 2020, we had that violent rally off the lows, the March 2020 lows. We rallied about 40%. And all of the commentators were coming out and saying, we're going to go back and test the lows. We don't have a vaccine. We're going to break the lows. And what happened? We went up another 50% instead. And I think we're seeing the exact same situation right now, is that everyone is saying, oh, we got to go test the lows. You have negative earnings. You have an inverted yield curve, et cetera, et cetera, et cetera. And the maximum pain right now is to push higher against a wall of worry. Just like we crashed 25% last year in anticipation of the slowdown this year, we're going to start to rally this year in anticipation of the earnings recovery next year. The second thing is everyone is buying VIX call options at a record pace. So they're buying insurance for a house that already burned down last year. Bad move. And finally, if you look at the Bank of America Global Fund Manager Survey, managers are the most overweight bonds relative to stocks than they were since the pandemic lows in March of 2020 and the great financial crisis lows in March of 2009. Those were times to buy equities, not bonds. And I don't know about you, Rochelle, but one thing is clear. Stock market does not top when people are overweight bonds. It tops when everyone's overweight equities and you run out of marginal buyers. And we're nowhere near that right now with cash levels and funds coming out of equities. So we think there's a lot of opportunity in the market to buy high quality companies that are on sale.
I mean, it's tough because, you know, a lot of people looking for the safety that they're used to in bonds. Do you think perhaps longer term there is a time to get in there, or have people already missed the boat?
Well, in terms of the equity market, I think on a company by company basis, you see high quality businesses on sale. I also think that, you know, people are very, very pessimistic about the recovery. And I think what they're underestimating, everyone keeps looking for the black swan, what's going to take this thing down. But actually, what's going to take this up is that the second largest economy in the world in China is reopening after 3 years of stop and start and major lockdowns, basically being offline for 3 years. Somehow the world economy managed to forge forward without them because they didn't have the proper vaccines, et cetera. And since they've opened, and it's only been 8 weeks, if you look at the composite PMI just last week alone, being at higher than pre-pandemic levels of activity, that's going to, you know, that rising tide is going to lift Europe. It's going to lift S&P earnings, and it's really just getting started. Even today, we saw box office tickets for the movie theater up 12% year on year in China. So I think that that is kind of a positive catalyst for the global economy that very few people are putting weight on because it's been offline for so long that you stop accounting for the positive benefits of that contribution.
And a lot of people have been waiting for this China reopening story to really pick up pace. But as you're mentioning, as you heard there, we heard from ECB Chief Christine Lagarde saying, inflation is still this global monster. People wondering, though, is it going to be a double-edged sword with the China reopening? Is it going to be fueling inflation while it's also helping with demand?
Well, it's interesting. Everyone looks to Saudi Arabia and looks to Russia for oil production. But while China has been shut down, what we see is that U.S. rig count has been creeping up back to near pre-pandemic levels. So while their demand was down a little bit and they built up supplies buying a lot of oil from Russia and Russia's production was still cranking even while they were shut down, they were buying at a discount. They built up a lot of storage, just like Europe built up the natural gas storage. But now you've got all this U.S. production getting back to pre-pandemic levels within months. And I think that's going to contribute and that's going to offset moving forward. So we're just looking for high quality businesses that are marked down. You can still buy companies like Amazon 55% off of its recent highs. One that we're looking at right now, Rochelle, is 3M. It's kind of this boring, sleepy company, industrial, transportation, healthcare, consumer. But it's trading at 11.5 times forward earnings, and that compares to its historic multiple of 17 times. Even its great financial crisis low multiple in March of 2009 was 14 times. So why is it trading so low? It has a legal overhang, 2 lawsuits, one of which the Department of Defense for earplugs came out last week and said 90% of people who use those earplugs actually had 0 hearing impairment. So that's a positive catalyst to help alleviate some of the litigation overhang. They'll pay the fine, they'll come to some settlement, and then the stock can move from there. They're also doing 2 tax-free spinoffs to unlock value to shareholders. So we think that's going to be a positive one moving forward.
You say 3M is a boring pick. I think investors could welcome a bit of boring after the year they've had so far. A big thank you, as always, Thomas Hayes, Chairman and Managing Member at Great Hill Capital. Have a good Monday. All right, coming up, China's modest growth target isn't exactly setting stocks on fire, but it could lay to rest some concerns over another inflation shock. We break down the impact on the commodities complex next. China sets a modest economic growth target this year of around 5%, sending oil lower as investors cautiously await remarks from Fed Chair Jerome Powell this week. We're here with the latest on the pulse on commodities is Yahoo Finance's Jared Blickery. Hey, Jared.
All right. Well, let's start with the big story, which is China, and just look at their GDP, and we'll get to the commodities and the effects that this is having on them in a second. But this goes back to early 1990s here, and these peaks here are about 15%, a huge amount for GDP calculations, as we know. And right here, this low is about 6.4%, and 6% was a floor until the pandemic hit, and then the bottom fell out, and China had negative GDP for the first time in decades and decades. And now we're talking about a target of 5%. So that's below that 6% that had previously been a bottom. So all of this suggests that we are in a new regime of growth going forward, not only for China, but also for some of its trade partners potentially as well. Now, first, I want to show what the effect is on the Chinese currency here. And we saw the US dollar firm a little bit versus the yuan. And if we take a look at a one-year chart, here's what happened overnight. Here's a one-year chart. We can see the trend has been towards a strengthening US dollar over this time period, except that Chinese yuan has been strengthening, I guess, since about late last year. Now, when we take a look at how this has played out in the equities markets, first let's take a look at the Chinese Golden Dragon Index and some of the components that trade here. And you can see a mixed board. Some of the bigger issuers, BABA, JD.com, those are up 1.5%. A lot of the smaller names down, and you can see those in the red here. But we're also talking about what's happening in the futures market, and the expectations for the use of global commodities. So kind of a mixed board right here. Forget natural gas for a second. That's down 13% today. That's kind of its own animal. But here we're seeing some weakness in the energy market. Heating oil down 2%. Also, oats are down 2%. But for the most part, not seeing a whole lot of fluctuations. Crude oil, for its part, that is now in the green. You can see in this chart from midnight last night, spending most of its time in the red. It is now clawed back. So in the end, I don't think the market was terribly surprised by this. But when you take a look at what's happened with the industries that the Chinese government is now supporting, notably that is in the property sector, that is not in sectors that would be conducive towards speculation. So the Chinese stock market, all these Chinese issues that had been darlings from years past, well, a lot of those are still 80, 90, 70% down. So not necessarily the case that those have to be coming back just because the Chinese authorities are turning on the spigots once again, because they're not the spigots. There's stimulus being applied very proportionally and directly into certain segments of the Chinese economy and not necessarily the others.
China certainly seems to be tempering expectations here, especially with that growth target, hence perhaps the slightly muted response we've seen. Jared Blickery, thank you so much. All right, well, President Biden reportedly closing in on the completion of an executive order restricting overseas investments in advanced technologies by U.S. companies in an effort to limit China's access. Here with the details is Yahoo Finance's Dan Howley. Hey, Dan.
That's right, Rochelle. We're looking at the potential for a new department being put into place to oversee these kinds of investments in foreign businesses. And the real thrust of this is to deal with China and its ability to grow its technological capabilities as well as its military capabilities. And that's really where we're seeing this, these kinds of large growth areas that provide China with the ability to quickly stand up businesses as well as expand their own abilities going forward, thanks to investment from businesses in the U.S. That could be managerial decisions, things along those lines that really just help push these kinds of firms forward. And so this would help tame some of that, and for the U.S. and its goals, help to cut back on China's ability to really grow and continue to be what it sees as a national security threat to the U.S.
So then on a broader scope then, Dan, what companies could be impacted by this pending executive order?
Yeah, look, there's a number of big name businesses, whether that's in the chip stock area, whether that's in data, things like cloud computing. There's a lot of businesses that China really has started to grow out on its own. And they're trying to become more independent of U.S. technologies. And so the flip side going to be dependent on U.S. technologies. It'll be dependent on U.S. expertise from these kinds of investments that we're seeing. And so that really could be the catalyst to help push China and its own efforts forward. I think for the U.S., that's the fear is that, look, we can ban the sale of technologies, we can ban things like that, but we can't ban investment. And so what they're trying to do is tamp down on that. If it's deemed that some of these investments would benefit both the commercial and military side of things, then the U.S. would likely rule against companies being able to invest into China in those sectors. And so you can expect this to be a hotly debated topic going forward. It's expected to come through as part of Biden's upcoming budget proposal. But look, there's going to be dejectors who say we should be able to invest our money as we see fit, regardless of where it goes. And obviously, from Washington side of things, it's going to be, well, that would be a national security threat to the U.S. And it's one of those rare bipartisan issues, I think, that you're getting out of Washington at this point is kind of the anti-China sentiment or anti-Chinese government sentiment. And so that could be a benefit to this provision in the Biden budget.
Certainly, in protecting those investments of the future that are really key to both of these global economies. Big thank you there to Dan Howling. Right, let's get a check-in on the markets here, sponsored by Tasty Trade. We see all three of the major indices touching session highs at the moment. The Dow up about 130 points, they're up 0.4%. The S&P also seeing gains there, driven by technology and communications, up 0.7%. And the tech-heavy Nasdaq up just over 1% at 130 points. All right, coming up, Tesla shares have been on a tear lately. We look at the impact on some of its biggest competitors. We'll also catch up with VW-backed player Scout as it plans some big moves in the space. Volkswagen-backed Scout Motors is giving the iconic Scout brand a modern makeover. An electric version of the off-road vehicle is set to begin production by 2026. Joining me now is the president and CEO of Scout Motors, Scott Keogh, and our very own Pras Subramanian as well. Very good to have you on the show. I'm a lover of all things vintage, and this model looks absolutely gorgeous, some of what you're coming out with this year. So talk about first this investment in the plant in South Carolina and what you're hoping to achieve there.
Look, what we're hoping to achieve is a home for Scout, and I think we found a home for Scout. If you look at the state, honestly, I think they did a magnificent job. To me, it comes down to sort of three pieces, right? The first piece, of course, is, let's say, the infrastructure. Is there the right energy? Is there water? And of course, we have that. The second most critical one, as you know, in America right now, is the workforce and labor. And if you look at South Carolina, particularly this Midlands area, there's employment, there's obviously available workforce, highly trained, all of the technical schools, all the engineering schools. And the third one, honestly, is the state itself. If you think about it, we were able to structure this deal in just over 60 days. I think, as you know, these deals sometimes take 12 to 18 months. So this is really a great moment for Scout. It's a great moment for the state, and that's why we're excited.
Hey, Scott, so this is going to be a $2 billion plant, 4,000 jobs coming to South Carolina. You know, VW also has a big plant in Chattanooga as well, so big U.S. footprint there for the brand. Was the reason why the Scout Motors EV plant's coming to South Carolina is because of the IRA? Is that play a big part in this decision?
Look, I think the IRA plays to overall investment in America. So I think if you look at the group overall, as you know, we have a big industrial footprint in China and Europe. And obviously, we want to strengthen our foothold in the North American region, in America. I think specifically for Scout, what this gives us a chance to do is take an iconic American brand, take the power and the backing of the Volkswagen Group, and act like a startup. Move faster, less legacy costs, less bureaucracy, and move fast and take advantage of capital markets and partnerships. So that's what we're doing, and we think this is honestly a chance of a lifetime, but certainly IRA is doing a lot to fuel investment across America.
You know, Scott, Rochelle mentioned that iconic heritage look of the Scout Motors, the Harvester, International Harvester cars, like the one behind you. You guys teased a couple images of a pickup and also an SUV. When are we going to see these action adventure vehicles out on the roads?
Well, you'll see the concept in early 24, and then live on the road, SOP is targeted for late 26. So obviously, we need to build a factory, and then that factory needs to build a magnificent car. But look, I think we're going to hang on to a lot of the loved legacy, if you will, the upright proportions, all the cool factor of this thing. But of course, electrification, all the technology that we have is going to make this car super cool and super fast and all the things you can do.
So Scott, how do you see yourself positioned between other models like a Jeep and a Bronco? What do you think that Scout will bring to the table that perhaps could give them a bit of an edge in the market?
Yeah, I think that's a great question. I think the first thing, if you look to the original Scout, what it did really well is, yes, it was a rugged, durable American vehicle. But I think what it also did well is it opened it up for America. And I think that's something we can do. We can walk this fine line between being rugged and durable, yet also have an everyday nature to it. I think the other magnificent thing we have is the fact that we're going to electrify this segment. This segment, for the most part, is not electrified yet. It's all internal combustion engines, and we can electrify it. We can meet the market at that time frame. I think the other thing is, of course, the brand and the product is important, but what we're doing is reinventing an entire company. And this gives us a clean slate with how we look at things. And I think that will be and is a competitive advantage. We don't have a lot of these legacies and bureaucracies and cumbersomeness. We can be smarter and leaner, and that's what we want to do. So it's a brand opportunity, but just as importantly, an all new company opportunity.
So Scout kind of carving out its own niche in the electric adventure market. You know, you mentioned clean sheet, no legacy really to speak of in terms of the costs. Sort of reminds me of Tesla, even though you're not kind of operating that same niche. There's a lot of learnings there, right, from Tesla?
Yeah, there is. And look, I don't think this is a niche. If you look at this segment, of course, we're going to launch a rugged SUV, and of course, we're going to launch a pickup truck off the same platform. These are the two largest profit pools in America. So these profit pools are massive. They make up over 50%. So it's going to be a big opportunity. I think if you look at electrifying, as you know, the market's only about 5% right now. It's going to move to 50%. So our goal is not to create a niche brand. Our goal is to create the next iconic American brand. Much like we look to Levi's or look to Apple or some other companies, that's what we want to do, restore this iconic brand. But you're right. I think there's a lot of things we can look to Tesla too. They've done a lot of things well. There's a lot we can learn. And yeah, we want to take advantage of those learnings. No debate.
And certainly a lot has changed since the company was first founded, even in terms of how Americans work and everything else. So interesting to see how Scout moves along with that. A big thank you there to Scott, President and CEO of Scout Motors. And Pras, of course, stay with us. We've got more on the EV space just ahead. Right, well, EV manufacturers are feeling the fallout from a Tesla-driven price war. China's BYD erased $18 billion in value the past month. So, Pras, what does that mean for BYD's outlook?
Well, you know, I guess it's more of a China story when we talk about BYD and not so much a Tesla story. There's a lot of competition there in the lower end, the cheap EV hybrid space that BYD operates. And BYD had a good year, a good February last month. Their sales were up 87% year over year. So they're doing well. It's just the fact that their stock price is getting hit. You know, a lot of it's peculiarities of the Chinese stock market, not exactly in the best spot right now. You also talk about Warren Buffett, that is unloading shares of BYD in the last few months. That's sort of not helping the matters there. So BYD sort of feeling a little bit pinched there in stock price. But, you know, from an operations point of view, they're still selling a lot of cars. They may have had to discount some of them to kind of compete. But if you look at it from a point of view of competition, Tesla in China at least operates at a much higher end, almost luxury market. So they're sort of operating there. They're cutting prices there to deal with NIO and other brands like that, whereas BYD is still growing share, but at a cheaper hybrid cars, smaller EV sort of market there for them.
So, Pras, do you think it'll make it difficult if Tesla does decide to come out with a much cheaper model than to compete with the BYDs of the world?
Well, I think that's going to happen, right? I think we're going to see that happen with the sub $25,000 car that may come. I mean, it may come to the U.S., I think not at sub 25, but around 25 to 30, maybe even cheaper in China with smaller batteries. I think that's the goal for Tesla, is to keep growing their sort of footprint and not at the expense of the higher end vehicles. They want to grow that lower end where they can actually, maybe they will be taken to BYD. But in China, you have more kind of a more mature market there for the cheaper, smaller cars. We don't have that in the U.S. here for cars with like 100 and 150 mile round range. It's not really a thing we do here, but in China, it's a big deal. So I think that BYD might be looking over the shoulder thinking of maybe Tesla will be coming in a few years.
Certainly one to watch indeed. Pras Subramanian, thanks so much. All right, time now for our chart of the day. And if you're looking to grow your wealth in 2023, listen up. Almost half of the respondents ranked real estate as a top opportunity in the Wealth Report's annual attitude survey. Now, participants explained that real estate offers greater control and value-add opportunities, serving as a hedge against inflation. Other top opportunities included tech, equity markets, and volatility. Now, the overall outlook for 2023 among respondents was, quote, positive but realistic, even against the backdrop of inflation and low growth. Per respondents, the biggest risk to creating and growing wealth in the year ahead will be inflation. Now, many also pointed to interest rates and geopolitical issues as potential threats as well. All right, coming up, food as medicine platform Farmbox RX finding a foothold and looking to expand its reach as families prepare to receive less food assistance benefits post-COVID. Stay tuned.
consumer confidence decreasing for the second month in a row in February. The index falling to a 3-month low on worries over a possible recession.
A decline entirely driven by expectations for the future. That means U.S. consumers keep feeling better about today and worse about tomorrow. We've got to talk about retailers, too. They're remaining cautious as inflation weighs on consumers.
We're just seeing a consumer that's making choices as they've seen the persistent inflation in a category like food and beverage, and that's taking a bigger piece of their share of wallet, and that's factoring into their purchase decisions.
I was at Costco this weekend, and let me tell you, those lines were incredible. As the consumer continues to gravitate and stick to those where value is everything for the consumer right now. They're looking for any way to save a penny.
Disinflation, like the Fed is out there talking about, is not necessarily happening. These companies are still dealing with high levels of inflation in their supply chain, and their customer base still dealing with high levels of inflation.
It's also a very bad macroeconomic situation right now where the consumers have shifted their spending. They're moving away from discretionary and sticking to staples. As a result, it's not the best scenario for the department stores in 2023.
I think the premium, the wealthier consumers are still doing well, and they're still pricing up, so to speak. Whereas the middle income and lower income consumers are not only scaling back some of their purchasing, but some of the features, some of the add-ons, some of the more premium components of leisure spend are beginning to tail off.
Now to the food security debate. More than 30 million people are set to lose up to $250 of monthly assistance from the Supplemental Nutrition Assistance Program, also known as SNAP, as the COVID-era boost ends on Wednesday. Now, Farmbox RX is hoping to provide an alternative with Medicare and Medicaid for food. Joining us now, RX CEO and founder Ashley Trenier. Thank you so much for joining me this morning. Obviously, with the government ending this SNAP benefit peak, returning it back to the standard amount, but people keep in mind, especially inflation when it comes to food, still at a high at the moment. How are you feeling about the government doing this, and perhaps some of the pushback? People are saying, look, it's going back to the standard. This is what it should be.
Yeah, I know. The reality is that cutting $95 from these individuals that statistically live off of $1,000 a month for everything, that doesn't seem like a lot to maybe you or I, but that's everything to these individuals. Inflation is at an all-time high. Grocery bills are at an all-time high, and it is not the time for the USDA to make this cut. And it's just going to have a trickling down burden effect to other dollars our government puts out around Medicare and Medicaid, with health disparities trickling down through that system because of these cuts.
So then talk about what Farmbox RX is trying to do with this company and who it can really affect. How many people could you impact with this?
So we came into the healthcare space in 2020 when the Center for Medicare and Medicaid changed regulations around food and produce being able to be offered as a benefit to Medicare and Medicaid recipients that have one of 15 chronic diseases. And so what we do is we partner with health plans to provide food to these members to engage them in other quality outcomes. We really created the food as medicine space within healthcare. There's still a tremendous amount of work that needs to be done there, right? There's not really a dedicated budget for food in our healthcare, which is, it's crazy, right? If you treat someone who has type 2 diabetes with better nutrition and better food, you're going to change that chronic outcome that they have, which would lower their claims costs, which is ultimately a burden to taxpayers.
And we really don't see as much focus on preventative care, especially when it comes to big pharma. So, talk about how you were able to get into this space, such a highly regulated space, using food as medicine.
Yeah, so we actually only got into this space because we were able to prove that if we engaged a member with a box of food, produce, medically tailored meals, we could get them to go take another quality measure outcome, things like go get their mammogram, go get their colonoscopy, different STARS measures that health plans need to get their Medicare or Medicaid members to go do of other preventative things. So it's really kind of crazy that we're engaging them with food, which can help prevent chronic conditions, But we're doing it to get them to go take these other measures for other preventative, like mammograms, colonoscopies, diabetic eye exams. So that's the only way that we've been able to get on, a health plan's budget, is by showing that we can have the member go do these other, necessary exams. I do think it is coming, because there is the 1115 waivers within Medicaid now that are coming out. There's 4 states approved. I think there's 6 in the pipeline. Where you could, send food to the Medicaid population, and then they study it over a certain amount of time. CalAIM has a program doing this right now, because they can justify that if you send food to members, you reverse their chronic condition, it's going to be less burden to taxpayers into the Medicare and Medicaid budget. But there hasn't been, and still isn't, a true budget for food.
And to that point, then, I want to talk about food deserts, because if all you have is access to fast food, you don't have access to fresh produce, and this is usually what you find in underserved communities. Talk about some of the economic impacts when you are stuck in a food desert, where you don't really have access to these things, what this can do for you economically.
Right. So, those that live in a food desert, there's rural and urban food deserts. And then you have to also think about populations that maybe could live across the street from a grocery store, but still that journey across the street is too far to get there, shop for their food, and get back home. Those that live in rural food deserts face higher chronic conditions because they don't have accessibility to fresh, healthy food. They have a lot of fast food available to them. And so then there's still this chase that goes on of, okay, if we give them the budget through SNAP to buy food, they still have to have accessibility. So you've got to be able to afford it, and you've got to have accessibility. What's happening with this cut of $95 on average per person with the USDA right now is it's going to make it that individuals are going to have to go to fast food, are going to have to go to less nutrient dense foods in order to just, stay nourished, right? And at the end of the month, there's a 30% increase that hits Medicare and Medicaid budgets because people run out of SNAP dollars. So they go to the emergency room to just get a meal. And that's very prevalent in our food deserts, especially in rural America.
And this is important for a lot of people. This hasn't been their reality. So it's important to get that information out there. People going to ERs to have to get meals. I want to talk to you about some of these either partnerships or perhaps rivalries. You have your Amazons and your Walmarts. They're already in the food space and the pharmacy space. You have Big Pharma, these insurance companies. Who do you see as rivals versus, say, collaborators?
We've been very fortunate that we don't have any true competitors right now in the market. We have over 100 health plans that we work with. We've really dominated the space. I would say that, Walmart is really trying to catch up on trying to bring healthcare to rural America. Amazon, they've made some acquisitions recently that they're really trying to push into healthcare, but Amazon is still trying to figure themselves out in healthcare, right? They've done some acquisitions that they've actually shut down. Instacart is also coming into the space as well of trying to provide food to individuals, especially those that are in food deserts and that maybe have accessibility problems beyond living in a food desert that they just can't get to the store. So there are some people trying to enter the space, but again, we go back to the Center for Medicare and Medicaid and the USDA. Our government systems don't really talk to each other. So with this cut coming from the USDA, it's going to hit the other, government sector of CMS, with individuals becoming more sick, more chronic disease is going to come down the line from this, and more unnecessary ER admits.
And in terms of funding for your business or where you would like to see it go and grow from here, depending on the sort of impact that you'd like to have, what's the next step for Farmbox RX?
We've been very fortunate that we haven't had to go raise any venture capital. We are right now actually in the middle of a fundraise. So we haven't to date. We've decided to go out and raise because we need to take, the opportunity that we have of the space we've created within healthcare. So we are in a growth round right now. We did 56 million in revenue last year, and we actually made money last year. So we were very fortunate to not have to go raise, but it also allowed us to create our own path, creating a new space and a new market. Investors would have had a very different idea than where I felt the company needed to go from day one. And now, we've done product market fit. So we've proven the model.
Certainly doing important work. We do appreciate you taking the time to join us this morning. Farmbox RX founder and CEO Ashley Trenya, thank you so much for joining me this morning.
Thanks for having me.
All right, coming up, some are calling Apple's eagerly awaited VR headset a potential game changer for the industry, but we barely know anything about it. Well, you'll know more after this next segment. Stay with us.
Fed testimony, quarterly earnings, and the monthly jobs report. It's a busy week ahead. Here's what you need to know. Fed Chair Jerome Powell will deliver his semi-annual policy report to Congress. Powell speaks to the Senate on Tuesday and to the House on Wednesday. Expect some fireworks. Both political parties have blasted the Fed's aggressive interest rate hikes. Powell has been critical of the standoff in Congress over raising the debt ceiling. There will be fresh economic data for the Fed to consider. The monthly jobs report is out Friday. About 200,000 jobs are expected to have been added during the month of February. The unemployment rate is forecast to stay at 3.4%, a more than 50-year low. Also in the coming week, watch out for earnings from Dick's Sporting Goods, Campbell's Soup, DocuSign, and The Gap.
For years, Apple has quietly been working on its own headset, following in the footsteps of other tech giants like Meta. But as new rumors continue to emerge about this new product, some are speculating it could be more impactful to Apple's bottom line than we first thought. Yahoo Finance's Ali Garfinkel is here with the details. Hey, Ali.
Hi, Rochelle. So the VR market hasn't yet had that hockey stick moment, the moment that sends it careening forward into the mainstream. But what I'm hearing from people is that experts are saying Apple's long-rumored VR headset could actually be that moment. It could help create that moment where mainstream folks really want to use VR. Now, why, right? The first is that it's going to simply be more welcoming, right? Apple is known for making products that are just so gosh darn easy to use and incredibly sleek design-wise. However, there's also the other thing to consider, which is Apple's ecosystem. Apple's ecosystem plugged directly into VR could be really powerful. For instance, want to watch Apple TV on your VR headset? Cool. Want to link it to your Apple Watch? Fantastic. So that's the kind of thing that's going to be on the table. And it's important to say that the VR market really needs that kind of kickstart right now. The VR market, along with the games industry at large, to be fair, saw its 2022 sales drop about 2% year over year to about 1.1 billion. That's according to research from NDP. And then now when Apple's headset does emerge, it'll also set up a battle we haven't seen quite so directly before yet in tech. Apple versus Meta. Meta, of course, has a pretty strong grip on the VR market right now. One source was telling me that he believes it's about 82% of market share belonging to Meta right now. That said, Apple entering the market, while it could be a tide that lifts all boats, could also undoubtedly pose challenges to Meta that they haven't seen yet.
And that's interesting. I mean, I understand it for gaming. I'm still trying to get my head around what I would need it for in everyday life, but I'll hold pause on that one. But we're also seeing Bloomberg reporting that Apple might be coming out with some new iMacs. So what are the reports saying?
Yeah, the new iMac is reportedly in the final stages of testing, and a lot of it is going to look the same as the iMacs we've seen before, the desktops. Same 24-inch screen, a lot of the same features and colors. However, it will probably be more powerful. It's likely going to have a new M-series chip. The important thing to say, though, is actually this has been 2 years since we've seen an update for the iMac. Now, why? I mean, sales data is actually going to tell us all we need to know about this. Desktops actually only make about 26% of all of Apple's computer sales. That includes iMacs, iMac Pros, and there you go. See, that's a pretty big gap. So that's why they've sort of focused on these laptops over the years. But that said, there are going to be a lot of people who are excited about the desktops. I know my dad is going to be one of them.
I mean, you know, Apple is always very careful. Like, it'll have the idea. We won't rush in, but it'll definitely have the idea and take your time and execute it well. It always does. Ali Garfinkel, thank you as always. All right, coming up, cybersecurity company CrowdStrike is getting a boost ahead of its earnings report tomorrow. We'll explain why next. Shares of CrowdStrike on the move today as the cybersecurity tech company joins forces with Dell Technologies to help organizations manage cyber threats and protect their endpoints, cloud workloads, identity, and data. Now, this coming as CrowdStrike gears up to report quarterly results tomorrow after the bell. So, of course, we'll keep a close eye on the latest there. Now, this afternoon, we'll hear from BetMGM CEO Adam Greenblatt for a pulse on the sports betting industry ahead, of course, of March Madness. And that's not all. Tomorrow, we'll speak with Sonos CEO Patrick Spence here in the 11 a.m. hour. We'll get a check on the state of the consumer spending and some new product launches from Sonos as well. And later tomorrow, IMAX CEO Richard Gelfond will join Yahoo Finance for a look at how movie theaters are faring, especially as we saw the success of Creed this past weekend, and also the state of play. Barbie maker Mattel CEO joins Yahoo Finance on the heels of their Investor Day. Of course, we've got a lot of big names on tap at Yahoo Finance this week, so be sure to stay tuned for all of that. Before we go, let's do a final check of the markets. We see here all three still in positive territory, but the Dow here losing a bit of ground. We see that the Dow is being dragged down a little bit by some news out of Boeing, reportedly delaying deliveries of some of its Boeing 737 MAX jets. That's Liam News and Air Finance Journal reporting that. But still in positive territory. We'll see the S&P also there up about 25 points as well, and the Nasdaq there up about 1% on the day as well. Let's also take a look at what we're seeing with treasuries after some of the highs that we saw last week. We saw a lot of people pouring into those bonds looking for a safe haven amid the volatility coming out of the Fed and inflation concerns. But as we see here, a little bit of a reversal here as we head into the new now with a little bit of a gain here for the 5-year, 10-year flat though, and the 30-year, the long-term yields there just up barely 0.08%. Well, that will do it for now. I'm Rochelle Akufa, but I will be back at 11 a.m. Eastern tomorrow. I'll see you then.